Good morning and welcome to Yahoo Finance. I'm Brad Smith alongside Shauna Smith. Happy Jobs Friday here. Of course, to everyone who celebrates, we're about 2 minutes away from the all-important jobs report for October. Non-farm payrolls are expected to show 100,000 in growth for the number of October and from the month of October. This number is going to be a major factor into what the Federal Reserve does with interest rates at its next meeting. That's coming next week. You're also taking a look at the unemployment rate. That's expected to come in at 4.1%. And year-over-year wage growth expected to come in at 4%, Shauna.
Yeah, I think there's lots of questions just about the volatility that we could see here in the wake of this, just because of so much uncertainty. Like you've been lying out, we've been talking about the hurricanes, the impact there, even the potential here for the Boeing strike, what ultimately that means here on this print. It could be a very noisy print. So again, investors are going to be trying their best to read through the lines as quickly as possible. The range of estimates for today's payrolls data is the largest that it's been in almost 3 years. So putting that into perspective. And then, of course, you got a lot riding on this print and just the overall health and sentiment of the economy ahead of the election next Tuesday. You're taking a look at this unemployment rate. We're right at 4.1%. If it does hold, that would be the lowest unemployment rate that we've seen at election time since 2000. So again, putting that in perspective, obviously 2020 was overshadowed by a ton of noise because of COVID, being in the midst of COVID at that time. But again, lots riding on this print and what ultimately that tells us about where we are in the economy, the health of the economy, and then, of course, the sector breakdown, too, what ultimately that tells us about any recovery that we could see.
Let's take a look at the setup here coming into this October jobs report. As we're taking a look at the major averages, we've got them on the bottom of your screen. Perhaps we can blow that up here just a little bit as we're taking a look at the Dow, the S&P 500, and the Nasdaq, all in positive territory, just seconds away from that jobs report. And, of course, the setup as well coming into it. We had a hotter than expected ADP private payrolls report earlier this week. And now we are finally getting the October jobs report, and it is looking like we ultimately are seeing the unemployment rate come in as expected, but ultimately the change in non-farm payrolls, just 12,000 jobs added during the month of October. That is a massive miss, even according to what was expected coming into this report, 100,000. And then you think about the revision as well of last month's report. Last month we saw 254,000 on the initial print. That was revised lower to 223,000 jobs here. The average hourly earnings growth month over month, that came in about 0.4% here. And then the average hourly earnings year over year came in line with estimates at 4%. But this massively different than what we expected here and lower than what we expected. Just 12,000 jobs added during the month of October here.
Yes, certainly. This is obviously coming in massively lower than what the street had been anticipating. I should say, yes, this is surprising just given the magnitude of how low this job growth is. But again, we could really see revisions come into play next month as we talk about the ongoing impact from the hurricanes and the strike and ultimately what that looks like. Like you said, the prior month was revised lower. Of course, we're also closely tracking the average hourly earnings just in terms of what that could tell us about where we are in the inflation cycle as well. On a month over month basis, you're looking at a rise of 0.4%, which is slightly higher than what the street had been anticipating, in line with what we saw the prior month. On a year over year basis, you're looking at a 4% climb, which is exactly in line with what the street had been anticipating and also flat from the prior month's reading. Labor force participation rate, paying close attention to that as well. That came in at 62.6%, slightly below what the street had been looking for in the prior reading of 62.7%. But again, we very much knew that this was going to be, or this could be, a wild number here. So again, modest payroll gains is what we are seeing. Unemployment, though, which is important, unemployment rate holding steady at 4.1%. And we aren't seeing much reaction yet here in the futures market here. Pretty muted reaction, which was also something that we did expect just given how noisy this number could be.
Yeah, just quickly here, taking a look at some of the sectors within this report as well. The Bureau of Labor Statistics reporting that employment continued to trend up in healthcare and government, but temporary help services that lost jobs. Employment also declined in manufacturing, and they say that that was due to strike activity. There's also a note here on the first page of this report talking about Hurricanes Helene and Milton, saying October data from the household and establishment surveys are the first collected since the Hurricanes Helene and Milton struck the United States. These hurricanes causing severe damage in the southeast portion of the country. They've got more notes within that, but no doubt just an acknowledgement and a nod to the impact of those hurricanes having an impact rather on this report as well here.
All right, let's break down this number further. Here with us in studio, we have Joe Bruce. He's RSM's chief economist, and we're also joined by Kathy Jones, Charles Schwab, chief fixed income strategist. Great to have both of you here. Joe, let me start with you. Just the magnitude of this miss, if you want to call it that, 12,000 jobs added to the economy last month. What's your first reaction?
All right, so this is a jobs report you want to take seriously, but not literally. The noise all over this report, it won't just be October, it's going to be November also. You can see the Boeing numbers inside the manufacturing complex, but also as I'm looking here, I'm seeing a pretty big downturn in professional business services, which is where you would expect individuals who work in retail, also in leisure and hospitality, which went down by 4,000. Those are going to be displaced workers because of Hurricane Helene. Now, the way we looked at this prior to the report was that we thought you'd get a movement in two parts. One would be October that would capture both the Boeing strike and Hurricane Helene. And then in November, we think that the Boeing strike will also be part of that, but you'll get Hurricane Milton. So essentially, guys, we're not going to get a clean look at the labor market until January of next year in the December report. Now, the 4.1% unemployment rate and the 4% increase in wages, that's a much better indication of the true underlying fundamental strength of the American labor market. Ignore that top line, look at that 4.1% and just get on with it.
Kathy, want to get your reaction to this report?
Yeah, I would agree with Joe that the non-farm payroll print was actually within the realm of what we would call the error range around what we were expecting. So if 100,000 was what was expected by the street, getting something even as low as minus 50 would have been within the range of possibility without it signaling a change in the labor market because of these temporary factors. So I'm encouraged by the household survey. I'm encouraged by the fact that average hourly earnings are hanging in there right around 4%. I would agree, kind of push this one to the side. Look at November and see what we can figure out from November, which may not be much, and then just keep moving.
Joe, do you think the markets are going to continue just taking this number in stride, just given that noisiness?
Yeah, this is all noise. It's just distortions. The market will move on, so will the Fed. We'll get that 25 basis point cut November 7th. But hey, guys, the U.S. economy is in such a strong position now. The Fed may choose to pause in December because they need to take a moment and ascertain if the growth path is meaningfully shifted up from the long-term trend growth rate of 1.8% that's embedded in their forecast to something closer to between 2.5% and 3%. Now, if that's the case, we'll see that, at least migration towards that, in their December SEP. That's a much bigger deal than any of this.
Kathy, are you anticipating that we'll still get the cut at the November meeting here? As we're taking a look at the CME FedWatch tool, it looks like there's still a 91% chance, or probability rather, for a cut that many out there are trying to perhaps bake into their own kind of estimates around how the markets should react to that.
I do expect the cut in November. There's a case for a pause, simply because we had those upward revisions to the September numbers. And as Joe pointed out, the economy has been growing at roughly 3% pace, which is well above what the Fed sort of thought was the run rate here. But I think we would have gotten some signal from the Fed if they were inclined to pause on the November meeting. A December pause, much more likely. And after that, the market's already anticipating a much shallower path of rate cuts going forward by the Fed. And I think that will be reflected in the next dot plot and the next SEP as the Fed comes around to this view that perhaps, the economy, due to productivity growth, due to underlying health in the labor market, the economy is really growing closer to 3%, and that would mean fewer rate cuts going forward than they had anticipated just a few months ago.
Joe, going back to what you just said a moment ago, that we should really be focusing on, one, the unemployment rate, and then two, just average hourly earnings, because that maybe is giving us a better picture of the labor market at this point. I'm curious, when you look at that 0.4% uptick that we did see in average hourly earnings, could that at all be skewed by the hurricanes and by the strike, or is that something that really just drills down past some of that?
We would have had a big move in a different direction if it would have. So I'm somewhat encouraged by the fact that that's on trend. Look, next Tuesday is the mother of all election days. If you're looking at the American economy right now, what do you see? You see economy that's growing at basically 3%. We're at full employment. Price stability has been reestablished by the Federal Reserve. Hell, gasoline prices are down 20% since 2022. We're in a very good place. So I think when we see these distortions caused by the storms and the strikes are serious, we don't want to discount that, we're in a pretty good place right now in the economy. This particular set of data is not going to derail that, nor will it derail financial markets.
So it sounds like you're still confident in the soft landing.
Oh, well, to be honest with you, we're in a mid-cycle expansion. Soft landing is a nice talking point, no offense, but this economy's moved beyond
And what
soft
makes you so confident of that?
Well, it's the fact that wages are now rising above inflation. We're on our 18th month now. It's a year and a half. Most people who've been talking about this soft landing was associated with the recession, no recession call. That's gotten a little stale after 2 years for me. What I see is a spending path that's 3 to 3.5%. Did you guys see that 11.1% increase in equipment investment inside the GDP? That's not an economy that's looking back or worried about risks of a downturn. That's a good forward look. It's a confident measure. And all of that noise around NVIDIA and that hardware is now being integrated in the production of goods and the provision of services. That's going to bode well for this economy in coming years.
You might be the most optimistic that we've had on the program in quite some time, Joe.
I think I might be, but you know what? My clients live in the real economy. They're not so much linked to trading. Those are two different worlds.
Yeah.
Our guys are looking 5-10 years out. They're making forward-look investments. And I got to tell you, our internal data tells us, this economy is moving at a 3% pace, and they want to hire. The problem is they're having a skills mismatch right now. I just don't see those risks. Now, if I was attached to a trading desk, I might say some different things about marginal risk because, obviously if you're trading, there are things you have to worry about that are very, very different intraday, interquarter, intermonth, right? Not now. This economy is booming. This is a good place to be. I was on with a different network this morning overseas. Let me tell you what, we pulled away from our G7 trading partners. As the economist said, we're the envy of the world. And I think it's good we start recognizing that because there's another set of risks that goes along with that. And Kathy was right on point. We're going to have likely a shallower path of rate cuts than what the market considered only 30 to 60 days ago.
All right, Joe Bruce-Boyle, it's always great to have you, especially in studio on a day like today. And Kathy Jones of Charles Schwab, thanks so much. Let's break down everything that's moving here after the report. Send it over to Yahoo Finance's markets reporter, Jared Blickery. Jared.
Well, thank you, Shauna. This seems to be a hot report, at least in the household survey, and we can break that down. But S&P futures, those are up about 0.5%. I'll show you the overnight price action. And by the way, most of these gains had already been locked in place before the report was issued at 8:30 a.m. or released, and we are just slightly above that mark right now. Here's the Nasdaq 100 futures. They were already up. We're just up a smidge more than we were at 8:30 a.m. And finally, here's the Dow. Dow futures are up to the session highs right now. But I've also been looking at the interest rates, and I was saying this is a hot report. You look at the wage growth, that's still very strong. You look at the unemployment rate, that's very strong. And here we see futures for the 10-year Treasury note, those are going up. That means yields are coming down. So those rate cuts getting priced in. And guess what? Equities like that. But in my mind, is a report just a little bit too hot. I think for all the talk of soft landing, and I agree with Joe there, it's probably played out by now. We need to think about the possibility of no landing, and that's kind of where my mind is after reading this report. Now, here is the price action in the sectors. Consumer discretionary up 1.84%. That's an Amazon story. So we still have earnings effects going on here, and I think that is actually accounting for a lot more of the market action. But energy is also up. That's up 1.3%. Real estate. The only sector that's in the red right now before the market open is looks like materials. That's down just about 0.9 or 0.1%. And I'd be remiss if I didn't take a look at some of these earnings monsters before we go here. Apple down 2%, but look at this. Microsoft up 1%. Its earnings were what? 2 days ago, but Amazon, that's up 7%. Meta up 85 basis points. And let's check out Intel as well. We had some interesting results there. Margins looking good, and Intel up about 7.5% in the pre-market. Brad.
Yeah, that Microsoft bounce back that you were talking about, Jared, of course, this morning coming after one of the worst days in, 2 years that we've seen for the stock. So we'll see exactly what transpires during today's trading session. Jared, thanks so much. Appreciate it. We'll be back with more analysis on what this October jobs report means for your portfolio. It's coming up next. The U.S. economy adding 12,000 jobs in October. That is well fewer than the number expected, 100,000 coming into the print. Weather disruptions and worker strikes weighing on the labor market. And our very own Danny Romero and Brooke DePalma are joining us at the desk for a deeper dive. Danny, let's start with you. You're actually watching housing and construction within this report.
It was no surprise that construction added 8,000 jobs in October. This is one of the sectors that honestly continues to have a lot of strong job growth because there's not a lot of skilled labor in this area, but there was some pullback as well. So we have to remember that construction is divided into two buckets. We have non-residential construction jobs and we have residential construction jobs. The non-residential construction jobs, really what that stood out to me there was the non-residential specialty trade contractors. And those jobs are the ones that really help build our roads, our dams, our bridges, and that gained about 14,000 jobs last month. Non-residential construction has seen a lot of strength, and that really comes down to the Bipartisan Infrastructure Act, which was passed in 2021, which triggered really a lot of job growth. It's also important to really note that weather-related impacts were really shown here because there was a pullback in hiring overall for construction.
And what about residential? Because we know we talk so much about just the shortage that we have seen in homes. What have those trends been looking like?
So residential construction is really unpredictable. That's what I hear from the experts. And here, this area gained about 1,300 jobs last month. Single family, we have to remember that single family housing starts, that got a boost in September. So there really was a little bit more movement there, but there was some pullback in multifamily. Really, again, the hurricane also had a lot of impacts overall when it comes to construction, because if you can't work under rain or those circumstances, there's going to be some projects that will be sidelined.
Yeah, absolutely. And Brooke, you're actually taking a look at hospitality within this report as well. What jumped out there?
A similar notion there. Hurricane Helene, Hurricane Milton really impacting this report and seeing a bit of a wipe here. We know that leisure and hospitality sector lost 4,000 jobs during the month of October, and that was largely led by a decline in arts, entertainment, and recreation. So that sector within leisure and hospitality lost 10,000 jobs. So performing arts, museums, those amusement parks that were impacted once again by that weather led down the sector by 4,000 jobs. Now, hotel and food services. Think about the other part of the U.S. economy that continued despite these weather impacts. That actually saw a gain of 6,400 jobs, and so that offset the report. Important to note here, we also saw hotel strikes from Marriott, Hyatt, and Hilton. That impacted the unemployment numbers slightly in October. We saw leisure and hospitality unemployment jump up 6%, and that was more than the 5.5% that we saw at this time last year.
And Brooke, and Danny, as we talk about the sector action that we've seen in this report, we also have to talk about healthcare.
Yeah,
some of the
that was a
action that we saw
driver.
there. Massive driver of this.
Yeah, we did see 52,000 jobs added to the healthcare sector within this October jobs report, and that's roughly in line with the 58,000 job gain that we typically see during this month. Ambulatory services led that drive, up 36,000 jobs, and that was followed by nursing and residential care, up 9,000 jobs. Of course, healthcare, leisure, and hospitality really ones to watch post-pandemic, as we saw them really struggle early on.
So healthcare, I guess, driving whatever gains we did see there this past month. All right, Brooke and Danny, thanks so much. We're taking a look at the market action following October jobs report. Futures are still pushing higher, holding on to those gains that we saw ahead of the release. Joining us now, we want to bring in Steve Risciuto. He is Mizuho Securities U.S. Chief Economist. Steve, we just got to get your thoughts on this headline number, obviously coming in massively below the street's expectations, just around 12,000. Unemployment, though, the fact that we are holding steady at 4.1%. To what extent does that offset any concerns that you have coming out of this report?
Well, I think the employment numbers have to be taken against the backdrop of all the noise that's been involved in that series, as you've kind of been alluding to in your previous segment. The unemployment rate kind of nets that out because it impacts both the numerator and the denominator to that extent, some extent. And the net result is we're not seeing any real change in the labor market. And the other thing is we saw a higher than expected hourly earnings number coming in at 0.4% as opposed to 0.3%. And it's that wage component that really keeps service inflation from going lower. So I think the net of this is it tells the Federal Reserve you don't have to rush to go back to where you think neutral is, you've got a fundamentally healthy economy, and jumping on the back of a weak payroll employment number after a fairly solid payroll employment number, I think would be a mistake, especially given the fact that long-term yields are up about 50 basis points from before they cut interest rates.
So you don't think they should cut in November?
No, I think they should wait. I think they should go on a very, very steady program. They shouldn't get the market convinced they have to go every meeting. And I think this is an opportunity for them to do that. Remember, the GDP numbers just came out the other day. They were almost 3%. They were 2.9%. There was over 3.5% sales to domestic purchasers, which is fundamental domestic demand. There was a higher than expected inflation component in the core PCE numbers. So I think when you look at the confluence of all the data, there's no reason to rush. There's no reason to convince the market we've got to get there quickly. You're better off doing this in a programmatic step-by-step function where you take some time to continue to assess data, and clearly jumping in on the backdrop of clearly a number that is influenced by the confluence of events you guys have all been talking about certainly doesn't add to the equation. It could actually push long-term rates up, and aren't we worried about rising long-term rates in terms of what's happening in the housing market?
Okay, and so what do you anticipate then investors should think about the 50 basis point cut that was put into effect at the last meeting? Because one could argue that was jumping not just to do 25, but to do 50 basis points. And then how do you think that'll be digested over time? Is this the successful digestion, you think, of a 50 basis point cut? And then from this point out, what does the policy pathway look like?
Yeah, well, I think the answer to your question is pretty simple. It's a good question, but I think the answer comes down to the market. The bond market sold off dramatically after that 50 basis point adjustment. And when you read through the minutes of the FOMC meeting, you got a real sense that even though there was one dissension, there were probably more in the room, and a little bit of backdoor arm twisting kept that from happening to keep the chairman's credibility. So I think the chairman probably pushed for that 50. I think all the data that's come out subsequent, other than this jobs number, but even within the report, there are other components saying there's no reason to rush. Again, I think there is no reason to rush. I think what they should do is do a very, very stepwise function where they go in December, they go in March, they go in June, they go in September, they go in December, and they get back to 4%. We think 4% is the neutral rate. They think 3% is the neutral rate. But we wouldn't have an economy growing at basically 3% if we were 250 basis points restrictive before they began cutting rates. And that's the real message. This economy is fundamentally healthier, it's stronger, it needs higher real rates than the Fed is assuming in their 3% target.
Steve, the market has certainly assumed that the Fed has inflation under control. When you take a look at the average hourly earnings here, the 0.4 of a rise on a month-over-month basis, are you as convinced as maybe the market seems as to where we are, where the Fed is in this fight to tame inflation?
Well, I think the Fed has one thing going for it, and that is that there's a global excess supply of tradable goods. And I think to a certain extent, you can leverage off that to move us back towards a neutral monetary policy and not worry about creating something greater than a 3% inflation rate. The problem for me is the bond market is where I think it's most mispriced, because the Fed is willing to tolerate 3% from everything they've been indicating, including in that 50 basis point reduction at September. They're kind of indicating that they tolerate 3. But if they're going to tolerate 3, bond yield should be closer to 5, not close to 4.
Okay, so all of this in mind, as traders are trying to figure out what their first portfolio repositioning should be, if they were to take what you're laying out into mindset and say, okay, if we're looking at, not every single meeting, but perhaps once a quarter, we're looking at a cut. What does that do in terms of the portfolio positioning from this juncture, how traders should be initiating their first trade once the session starts today?
Well, let's take it this way. If I was an investor in this market environment, I would probably look to reduce my duration. I'm not being penalized in my interest, by reducing my interest component of my asset purchase because I'm getting almost equivalent levels at the front end of the curve as I'm getting at the back end of the curve. And certainly if I'm in bills, I'm getting a bit more than that. So I'm not losing on the interest component, but I am protecting myself against duration risk. And in an environment where the Fed is willing to tolerate an inflation rate that's not being priced into the market, I'd rather be in a position where I'm hedged to then not deal with the capital loss by rushing out and buying the long end of the curve. Here again, I think if the Federal Reserve were to take the more slow path, then I think you could argue that maybe there would be an argument that the Fed is going to allow inflation to come down from global excess supply and possibly 2% becomes a reality. But if they rush down the path of getting to their neutral, which is 3%, I think we really run the risk of embedding a 3% inflation rate in the curve.
Steve, I know you're an economist, but you just gave us an excellent answer for how some of the strategists might also be evaluating the first trades this morning for some of their clients out there. Steve, always appreciate the time. Steve Rasciuto, who is the Mizuho Securities U.S. Chief Economist. Appreciate the time.
Cheers.
Thanks. Let's get a quick check on markets here as we are just outside of 30 minutes away from the opening bell here. Taking a look at the Dow Jones Industrial Average, the major averages across the board are actually in positive territory coming off of that October jobs print here, which actually showed the U.S. economy add fewer than expected jobs. 100,000 was expected, 12,000 is what we got. Let's take a look at yields as well here. Taking a brief look at treasuries here on the screen. You're seeing those down as of right now. 1.78% is where lower is where you're seeing the 5, the 10, and the 30 are also down. And then finally taking a brief look at the dollar here. We're taking a look at the U.S. dollar down by about 0.25% here right now. We'll have much more coming up on payrolls on Morning Brief in just a moment.
It's 9 a.m. here in New York City on this Friday, November 1st. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the 3 stories that you need to know today.
Good morning, everyone. First up, a U.S. future is pushing higher after the October jobs report showing the U.S. economy added only 12,000 jobs in the month of October. The payrolls report coming in well below the average estimate of 100,000. The unemployment rate, though, that held steady at 4.1%.
Plus, a mixed bag for big tech earnings. Apple shares falling after the company offered a tepid sales forecast, which added to ongoing concerns about a slowdown in the China market. Meanwhile, shares of Amazon and Intel pushing higher after the e-commerce giant reported stronger results in cloud and commerce, while the struggling chip company offered some signs of optimism over its turnaround as its revenue outlook beat estimates.
And Boeing and union leaders, they've reached a new deal that includes a 38% wage increase over 4 years and a $12,000 signing bonus. The 33,000 striking workers will vote on the tentative deal this coming Monday to end the 7-week strike.
A bad news might be good news reaction in the market this morning following payrolls as investors look past the 12,000 jobs, just 12,000 jobs that were added in the month of October. Joining us now, we want to bring in Brian Jacobson. He's Annex Wealth Management's chief economist and strategist. Brian, it's great to have you here. So let's start with the market's reaction before we get to really what this reading tells us about where we are in the economy, if anything. But the market's reaction has been relatively muted. We haven't really moved off of the gains that we saw prior to this print. What does that signal to you, and is that the right read?
Yeah, thank you for having me. And I think that really what the market reaction is appropriate here, because we knew that the numbers were going to be very messy. It was going to be distorted by the Boeing strike and then also the hurricane effects. I personally was expecting that we were going to see a negative number for the payrolls just because of some seasonality effects. And also I was not sure what the response rate was going to be for the various surveys that they do. So in a way, I'm kind of surprised that we had a positive number there. But the market reaction here is, I think, one where it gives the Federal Reserve the green light to cut if it wants to, but it doesn't necessarily need to. And so we see yields coming down. We see the market staying fairly high as far as what the futures, as far as the rally off of Amazon's numbers. And I think it really does just paint a picture where it's a very cloudy picture. And so it's one where maybe the Fed, the best thing they can do is just stay the course, do what they laid out that they want to do in that summary of economic projections, which would be a 25 basis point cut next Friday, and then another 25 basis point cut in December.
What's the risk of cutting too quickly here? I mean, we have seen within the CME FedWatch tool, 50 basis points get put back on the table. It's a very small probability, we should mention as well, though. And much of that probability is still weighted towards that just 25 basis point cut here. But if the Fed does go too quickly, are we risking inflation once again just jumping back up?
Yeah, I think that if the Fed moves too quickly here, it's going to affect inflation expectations. So that's a key driver over the intermediate term about what realized inflation is what are people expecting it to be? And so if the Fed does do another supersized cut, it does run the risk of unanchoring those expectations and making the Fed's job harder in terms of hitting that 2% target. I don't think they need to do a 50 basis point cut. I think what the market, why they might be pricing that in, is almost like an insurance thing as far as, well, there's a possibility that let's see what happens with the election, that maybe they're going to feel like they need to do a bigger cut. I don't subscribe to that idea. And so I think that some people are just making somewhat of a crazy bet when it comes to expecting the Fed to move by 50 basis points.
But Brian, what about the flip side of that? Others who are saying that, hey, maybe the Fed doesn't need to move now.
Yeah, I am sympathetic to that idea that we've got a good thing going. why ruin it, right? Why do you need to cut? And in fact, if we think back about 10 years ago at the St. Louis Fed, President Bullard, that was his argument for why do we even need to raise rates back then when we were at 0%? He's like, we've got a good thing going. Why not just keep it where it is? I think the biggest argument in favor of not actually just staying the course is rates are still restrictive. If we look at the beige book, if we look at the various sentiment surveys, so a lot of that soft data is giving a different picture than what we're seeing with the hard data. But keep in mind, the hard data that we get, it is subject to revisions, all sorts of error bands. So for all we know, if a year from now, when we look back at today's report, it could be something very different. And so the Fed, this hard data, is actually kind of squishy.
Brian, all this in mind, and if we can put your strategist hat on, because I know you wear multiple hats over there at Annex. So if we put the strategist hat on, what is the trade that investors should be kicking the tires on, or at least marking out here, or trying to figure out how it fits into their portfolio off of a report like this, and gaming out what you were mentioning in terms of the Fed's pathway from here?
Sure. Yeah. So on our investment committee, when we were looking at the numbers this morning and then also all the earnings reports that have been coming in, we do think that it really makes sense to try to broaden your diversification. A lot of people are probably sitting on very high concentrated positions in some of the highest flyers of the last year. And so it probably makes sense to look at get a little bit more of a value tilt to your portfolio, because you might be a little over your skis on the growth side of things. Or take a look, how much exposure do you have to the mega cap space? And let's not forget about mid caps. Mid cap stocks, in my mind, represent a decent value opportunity relative to the large caps and a quality opportunity relative to small caps. So higher quality, lower valuations, it's in that mid cap space. But then also with bonds, people might be a little shell shocked from the moves that we've seen in yields. So just when you thought it was safe to get back in the water, all of a sudden, the bond vigilantes are swimming around and the sharks are pushing those yields higher. We think now is a good time to maybe go bobbing for duration, kind of like bobbing for apples. Just take a little bit more bite out of a few more of those long-term bonds. You don't have to get over your skis on these things, though.
I don't trust enough people to go bobbing for apples around them. Brian Jacobson, who's of Annex Wealth Management, thanks so much for taking the time. Appreciate it.
Thank you.
Let's turn now to the other big story of the day, Amazon and Apple earnings. Let's kick it off here with Apple as we're taking a look at shares down pre-market here by about 1.6%. Of course, there's so much focus with this company always around the iPhone because of the lion's share of the revenue that it does bring in. That iPhone actually set a September quarter record, $46.2 billion. That was up 6% from a year ago. And they mentioned on the call that it had growth in every geographic segment here. And of course, they also use that opportunity to talk about some of the features that are going to be coming with Apple Intelligence once they finally do hit. But I might have finally been sold on getting a new iPhone.
Really?
Maybe. Yeah, based on what I heard on the call, I think I'm ready. And based on my cracked screen, I think I'm ready.
Yeah, on your cracked screen alone, I think that might outweigh anything we heard on the call. But I think there is still certainly a lot of uncertainty when it comes to Apple in the future and really what the next couple of quarters hold, especially with China. That weakness there really overshadowing some of that better than expected news that we are getting out, or that we did get out last night. And that's one of the reasons that we are looking at some pressure on the stock here this morning. A lot of that guidance, investors questioning how long some of that weakness is going to last. Some of the quick reaction that I'm going through on the street here this morning saying that it is anticipated that China is going to remain a weak market here looking ahead to fiscal Q1. And then I think beyond that, as we talk about some of the other disappointments maybe within this report, you're taking a look at services revenue as well as iPad wearables. That all missed on revenue. Guidance also coming in just below expectation. So again, another reason why we are seeing the stock under a bit of pressure. Beyond that, though, there were some highlights when it comes to the new iPhone, the new upgrade cycle, what exactly demand looks like for that, the fact that that did come in better than expected, the fact that we are seeing maybe slightly higher demand than many had forecasted, especially on the heels of so many research reports and various surveys that have been published over the last several months, alluding to the fact that maybe some of that uptick was going to be more muted. So I think that puts some of that debate at least to rest to now. But I think a lot is riding on what exactly Apple Intelligence looks like down the line. as we do get the next iteration release and exactly what that's going to do, if it is going to be enough to spark a real demand here for that cycle.
Yeah, apple pie in the sky hopes for services here. And the reason I zero in on that is because, as you mentioned, it was something that the street expected to come in better than it did. Let's not forget that it still was a record quarter for services, an all-time revenue record of $25 billion. If you carved out this services business alone on an annualized rate and say you apply that $25 billion across 4 quarters going forward from here, that's a $100 billion business in itself sitting within Apple here. So at the end of the day, there's so much margins that they can extract from that services business and really invest into other parts of the Apple ecosystem and the Apple sphere, if you will. And I mean, yeah, for the disappointment that there may have been from the street, I still am looking at this and saying, okay, there's still a lot of value within that services business.
Yeah, and I also think, just going back to the iPhone, to the Apple features that rollout, what the additional rollout is going to look like, just in terms of whether or not it's going to really significantly boost that demand going forward. What it's going to look like in the coming months will certainly be very telling, I think, as you look ahead to even a year from now.
All right, we mentioned Amazon as well. We should probably talk about that. Shifting gears to another member of the Magnificent Seven, Amazon. The e-commerce giant beating Wall Street's estimates on both the top and bottom lines. $158.8 billion in sales and an 81% increase in capital expenditures driven by some of those artificial intelligence investments here. Joining us now to break down some of these results and what's next for Amazon, we've got Nick Jones, Citizens JMP Equity Research Analyst. Great to have you here with us, Nick. All right, so first and foremost, let's just zero in on the amount that they're investing within artificial intelligence. Is this for what the street is anticipating and how aggressive they are going to continue to be in spending? Is this kind of something that is a good marker? Is this something that you hope they begin to taper off sooner rather than later?
Yeah, I don't think folks expect spend to taper off. This is an environment. If you look back in history, companies who maybe didn't spend ended up losing down the road by not being prepared for kind of the coming technology. So I think when you kind of hear commentary from Google, Meta, Microsoft, Amazon, spend is going to keep coming here. AI is this massive opportunity. We're only a year or so into the opportunity. So we're probably looking at a very long runway of spend. I think investors are really just trying to get their arms around what should that level be. For Amazon, they guided $75 billion in capital expenditure this year. The only color they gave us for next year was they'd likely spend more. Conversations with investors, we're hearing people are already kind of earmarking 90 billion plus. That's 20% year over year on capital expenditure. So it's a huge opportunity. Most companies are they're capacity constrained, really with chips being the choke point. So given how big the opportunity is, we're probably going to see a lot of spend here for the next several years. That said, Amazon delivered really good operating income margins. That appears to be the key indicator for the stock now. And it's really interesting because over the last couple of quarters, it was really AWS growth. Now it's coming down to, hey, we're ready to give you guys growth with expanding margins, and that's what they've been delivering.
And that was a nice surprise here for the street. Going back to that spend real quick, it sounds like you're comfortable with those levels, Nick.
Yeah, Amazon's a dominant cloud player. They're going to want to be dominant in AI. They need to keep spending. I'm very comfortable with their spend. I prefer that they spend versus kind of getting behind the 8 ball down the road and not having the capacity or the chips to provide their customers what they want from an AI perspective. So I think this is a little inflammatory, but it's kind of spend or die kind of environment where if you let your competitors get ahead, you will be behind in the future.
Yeah, well, we heard Jassy call it a once-in-a-lifetime type of opportunity. Nick, what does that longer-term potential then look like here for Amazon?
It's just massive. When we look at IT spend, I mean, so much is still on-premise. That's going to move off-premise to the cloud, from internally managed servers to the cloud. He said about 10% has shifted, and he thinks that ratio will switch to where 90% will be shifted and 10% will be on-prem. We verified that with kind of our analysis, and we think that's right. There is just a multi-decade runway here for everything shifting to the cloud, from the media we consume to the processes we do at work to where we store our files across the board. So we agree. It's a massive opportunity that deserves kind of the spend it's getting.
Okay, interesting. So, Nick, as we're thinking about the other elements of Amazon's business that are perhaps a little bit more household known, is there any exposure or any risk that you're kind of analyzing with the consumer environment right now? How do you look at the e-commerce side of the business, which is much more well known by the kitchen table at home than the cloud side of the business?
Yeah, we like Amazon's e-commerce business a lot. They've been winning wallet share, and we've really been, doing some work as to why that is. Temu and Shein have come in for fast fashion, steeply discounted home goods and electronics at Temu, and Amazon can compete there. They have a low-cost storefront they're rolling out, but really what Amazon can win at is you can get what you want tomorrow, or in 2 days, or in some cases today. So consumers, they're looking for discounts, and they're kind of steering away from other kind of options, right? There's a ton of D2C companies out there, a ton of other marketplaces, yet Amazon and Walmart are getting that wallet share. We think what consumers want is they want convenience, right? They want a great consumer experience. They want good discounts, and they want certainty that, one, they're going to get it when they say they're going to, the platform says they're going to get it, and there's easy returns. Given that returns is a huge factor for a lot of folks. Can I return this? So they've built one of the best e-commerce platforms out there. The kind of vertically integrated logistics network gives them a massive, massive advantage. They're now going to start rolling in medications for pharmaceutical prescriptions that people are going to have. They're going to try to do delivery within a couple hours to 24 hours to 48 hours. So again, they just can beat pretty much anyone on experience and delivery times. So really strong platform that we like.
Nick, as Amazon, it sounds like it might be a top pick of yours.
It is. This is definitely the top pick we have right now. E-commerce platform should continue to win wallet share. The advertising platform is incredible. I mean, when you really think that they can see that you see a commercial on Thursday Night Football and then also see that you pulled up your app to buy the thing. That is an attribution model that no one can really compete with. So they've really got this awesome platform. Kuiper is going to offer internet service in a few years. The cloud business is doing really well. AI is integrating into all of their businesses as well. Really a lot to be excited about at the company.
All right, Nick Jones, always great to get your insight. Thanks so much for joining us here this morning. Citizens JMP Equity Research Analyst. Coming up on Morning Brief, we break down Intel's latest report as shares push higher on turnaround optimism. Plus, Boeing and union leaders reaching a tentative agreement. We've got those details ahead. And we count you down to the opening bell on Wall Street, stocks kicking off the first trading day of November. It's hard to believe. We got all that and more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's go to the skies. Boeing and its machinists union, they have reached a tentative deal to end a 7-week-long strike. Boeing's latest offer would raise wages 38% over 4 years. The previous deal to raise wages 35% over the same period, that was rejected last week. Now the vote will take place Monday, November 4th here. The union urged workers to approve the contract, writing in a statement, "In every negotiation and strike, there is a point where we have extracted everything that we can in bargaining and by withholding our labor. We are at that point now." End quote. So as we're taking a look at shares of Boeing, they are reacting positively here. Perhaps investors just saying, finally, an end in sight to this. And I imagine that a lot of the air carriers that they work with as well are saying, yeah, finally an end in sight to this. So when can we get some of those orders delivered? And it's going to take some time for that backlog to really be worked through. We heard at the beginning of this week from Bob Jordan, and ultimately him saying Boeing needs to be better, really joining the chorus of other CEOs in the airline industry saying that they need Boeing to be better. They need Boeing to be able to deliver upon the aircraft that many of these airlines have been waiting for right now.
Yeah, certainly when we talked to Bob Jordan, Southwest CEO, earlier this week, he was, I don't know if I would use the words critical, but was very straightforward just in terms of his feelings on Boeing and what exactly needs to happen just in terms of being that reliable partner going forward. Let's talk about what is riding on this specifically. One is the fact that we've actually been here before, not too different than what it looked like several weeks ago. Again, so we will see whether or not this actually gets pushed to a vote, or it is being pushed to a vote, but whether or not it actually gets approved. Clearly, this is is potentially a critical win here for the new CEO, Kelly Ortberg. He has a lot riding on this. He wants to move forward with his plans to rebuild Boeing, helping to improve the culture down the road. He very much wants to put this behind them. In terms of what this has cost Boeing so far, there's a recent estimate out from Anderson Economic Group saying the strike has caused an estimated $9.66, nearly $9.7 billion in total economic losses, far outweighing the early October walkout by dock workers. So putting in perspective from a macro standpoint, just what exactly the impact of this ultimately has been so far. And you got a question, and this was written up a couple of times here over the last 24 hours, but if we do get a no vote on this, you have to wonder what the incentive is for some of these union workers, whether or not it's deliberate at this point, just given the fact that it does look to be, at least from the surface, from the headline numbers and all the details that we've seen, a pretty lucrative offer that's being put forward.
Yeah, $12,000 signing bonus. So that's basically, depending upon what you're salaried at as a machinist, that basically kind of eradicates some of the losses that you may have seen over that period of time because of the stoppage of work. So checkbox there. Then additionally, you talk about what you're getting back here in the wage increases as well. That's what you were looking for. And so this should be brought to a vote, and it will be, and it should be approved here. Now the question is, okay, how quickly can Boeing communicate back to the other airline carriers that are relying on them for deliveries that they will be able to move through that backlog? And many of them have already pushed out their estimates for taking delivery at this juncture, which could impact everything from route schedules to capacity, and ultimately how much they have to pay for maintenance on their existing fleet as well.
Yeah, so a hurdle that could potentially be put in the past for Boeing. But again, when you talk about the groundwork that's being laid just in terms of the recovery, far from that being anywhere close to being done at this point. Well, turning to the energy space, oil and gas giants Chevron and Exxon both reporting third quarter results before the bell today. Both companies beating adjusted profit expectations as rising oil production in the Permian Basin helped offset a decline in oil prices. Joining us now for a closer look at this is senior markets reporter Ines Ferre. Hey, Ines.
Hey, Shauna. Yeah, and investors liking what they're seeing in this report, even though profits on a year-over-year basis are down. If you take a look at what the stock's doing right now, the stock is reacting positively in pre-market, up more than 2% for both ExxonMobil and also for Chevron. Exxon's profit coming in at $8.6 billion in the third quarter. That's down from the same quarter last year, but CEO Darren Wood saying that the quarter was one of the best third quarters they've had in the past past decade, or the best third quarters they've had in the past decade. And in the upstream, also saying that they had record volumes coming from Guyana and the Permian Basin. Chevron's profit was considerably down from the last quarter, but still beating analyst expectations. In Chevron's case, you had the profit decline that in part was because of lower margins and refined product sales, also the absence of favorable tax times. But look, if you take a step back and you really look at what's going on, you had in 2022 the invasion of Ukraine, and so you saw oil prices spike, and that's where you saw these record profits for these big oil majors. Since then, you have had record production. You've had a consolidation in the energy space. And so you have had this range bound when it comes to crude prices. And we've seen a lot of crude volatility prices. You have spare capacity on the sidelines from OPEC Plus. So you are seeing lower prices, obviously, than what we saw in 2022. The important thing for shareholders is the buybacks, the dividends, Exxon returning almost $10 billion in the third quarter, also raising their dividend, Chevron returning a record of $7.7 billion to shareholders in the third quarter. And if you take a look, also, I want to show you on my Wi-Fi Interactive, if you should take a look at the year to date for both of these stocks, a little bit of a different trajectory year to date, because you have ExxonMobil that year to date is up 16%. Meanwhile, you've got Chevron that year to date is relatively flat. The big thing with Chevron, of course, what analysts are pointing to is that overhang of that acquisition of Hess in arbitration. So that has been an overhang. That's expected to continue into 2025, guys.
Inez, just briefly while we have you here, also wanted to ask you about the moves that we're seeing in oil today here on reports that Israel is preparing for a retaliatory strike from Iran. What do we know?
Yeah, and we saw, remember, on Monday that oil prices were down 6% after Israel had attacked Iran and it spared its oil facilities. And then we saw kind of the markets believing that, well, perhaps this would be, this is toning down the escalations now. And even Iran's response at the time, even though they condemned that attack, they weren't talking about a retaliatory attack. Now you have Israeli intelligence saying that they believe that Iran could attack before the elections, actually. And so part of the reason why you're seeing this oil moving up right now is because of perhaps the tensions are higher than what we had expected. You also have something else going on here, and that is a report that came out this week from Reuters saying that OPEC Plus could delay its unwinding of its output cuts. Remember that OPEC Plus in December was going to start unwinding some of those production cuts, so we would be adding barrels back into the markets. That may not happen for another month or 2 months or who knows when, because this has been delayed before. So the combination of those two things are sending oil prices higher today.
All right, Inez, thanks so much for breaking all of that down for us here. Just a few minutes until the opening bell on Wall Street. Stay tuned. You're watching Morning Brief. That's the opening bell on Wall Street. Let's do a check of the markets as we kick off a brand new trading month, the first trading day of November. You're looking at gains here on the back of that very weak jobs print. It looks like at least the market, I guess you could characterize this as looking as bad news as good news, at least for now. I think the real reason here behind this move is just so much uncertainty is being baked into this report. Not too much emphasis is being placed on that very weak number that we got out this morning. Many investors, when you take a look at the equity market and the bond market, looking past that weak report and ahead to the election next week and also the Fed meeting. They will, of course, be critical here in terms of the direction that we could go forward for equities. But again, when you take a look at the Dow, you're looking at gains just shy of 200 at the open. When you flip over to the S&P 500, we are moving slightly to the upside, still below that 5,800 level that we had to cross and we're above earlier this week. Take a look at the Nasdaq as we wait for that to calibrate, and take a look at the bond market. A bit of a drop here in yields, off just about 3 basis points, still in that 4.243 range, a range that many fixed income strategists have talked to us about, that we could potentially be likely to stay range bound in here over the next couple of weeks. Potentially here we could push above, I guess, to that 4 or 5 level that of course has been floated. We're taking a look at Bitcoin moving slightly to the downside here, still though holding above that 70,000 level. Looking inside the market, some of that sector action first here as we flip the board and try to figure out where we are in this thing. Taking a look at the sector action, looking at consumer discretionary, by far the leader in today's space. We also had a number of the big oil giants reporting out before the bell, Chevron and Exxon. That's helping the energy sector up over 1% here. On the flip side, you've got utilities as the underperformer. And let's take a look inside the Dow. Given the earnings results that we have gotten out here, you're taking a look at Amazon, a very, very strong number from the company. That's helping a huge pop here, helping the stock really pop here at the open. You're looking at gains of just about 7%. Also, when you take a look at some of the oil giants here, you got Chevron up just about 3% here at the open. You're also looking at Exxon pushing to the upside as well. On the flip side, you got Apple, a bit of a disappointment when it comes to guidance as a result, weighing on shares just a bit today.
All right. We're going to continue to track the market activity. Of course, we're early innings here, early moments in today's trade. But with a 1.5% slide in the S&P 500 Thursday, wiping out the benchmark's advance for October, halting a streak of monthly gains that would have been the longest since 2021, what can we expect in November ahead of the election and the Fed's next meeting? Joining us for more, we've got Rob Hayworth, who is the U.S. Bank Wealth Management Senior Investment Strategist here. Rob, good to have you on Yahoo Finance here with us this morning. So what is the setup now that we're kicking off November and you've got a major event, of course, 2 major events taking place in the same week in the election and then also, of course, the Fed's next meeting where we'll hear a little bit more about their pathway forward coming off of that massive 50 basis point cut that we saw in September?
Yeah, it's been a busy 2 weeks, and we're going to strap in for next week as well. It's going to be very busy for us with those 2 events, especially in the wake of the news we got today and last week, right? A lot of uncertainty really about the labor market at this point because of the weather-related data. So we're thinking more volatility next week, particularly as the election goes, because it's probably, given how close this is, it's unlikely we get a result Tuesday night. That may extend for some time. The Fed meeting is Thursday instead of Wednesday. We'll have to see what the Fed does. The market now thinks the Fed's definitely cutting 1/4 of a point and maybe will go a half. That seems unlikely. They'll probably cut by just 1/4 and set themselves up for maybe another cut in December, depending upon how the economic data continues to unfold, especially as we get through the weather and strike-related data. So we're kind of bracing for more market volatility as we look ahead. We're staying neutral in our portfolios, looking for those opportunities to arise because we think they very well could, right? Because underlying that all, we've got between this week and next, 54% of the S&P 500 reports earnings. So a lot of data coming our way that we really need to ingest. Probably means more volatility, but also more opportunity for investors as we look ahead.
So, Rob, should investors then be looking at any sort of pullback then as a buy the dip opportunity?
We think so. And really the reason is we're looking at earnings expectations as still constructive. We're looking at 240 really for the rest of 2024. We'll have to see how that pans out. But expectations are really pretty robust still for 2025. Around 274 on the S&P 500 is where consensus is coming in. That's maybe a little elevated. That could come down a little bit in our view. but that's still pointing to double-digit earnings growth in 2025, which is very constructive for this market as we look ahead. Even at these high multiples, that growth story still looks fairly positive.
What do you think the catalyst is for that growth story?
Well, frankly, one, the Federal Reserve is cutting rates, and that will help this economy and the earnings story. Two, even with the soft hiring data, that unemployment rate at 4.1% is still quite low. So we're still an economy with people at work, people earning incomes, right? We had good average hourly earnings growth. So that's going to drive consumer spending even into next year. We've seen very solid GDP prints for all of this year. It may soften a little bit into next year, but that's still enough to keep corporate earnings moving ahead. And lastly, we've got this investment cycle that's still happening, maybe a little slower based on the earnings result we saw this week, maybe a little slower in terms of artificial intelligence spending, but we still have this earnings cycle, this investment cycle moving ahead, which will be supportive into next year. So the story, the backdrop, there are certainly risks, but the backdrop for this is very solid.
All right, Rob Hayworth, great to get your insight here this morning. U.S. Bank Wealth Management, thanks so much for joining us.
Thank you.
We've got much more of your market action ahead. Again, just 6 minutes into the trading day, you're looking at gains across the board. We'll be right back.
Intel shares pushing higher as investors turn positive on the company's turnaround efforts. Yahoo Finance's Brian Sozzi had a chance to sit down with Intel CEO Pat Gelsinger following the results.
Teasing them apart a little bit because there are charges, impairments, and a lot of these are accounting charges having to do with accrued taxes against losses or future profits. Also a goodwill charge. So a lot of those are, I'll say, accounting charges that really don't affect the business in any way. They're not cash. The two that really deserve a little bit more conversation, one is the severance charges, that are associated with the people actions that we've taken. And those people actions, hey, we're right-sizing the business. We did a clean sheet, analysis of what it means to have a competitive business structure for the long term for foundry and products. And the other one then is we did have some equipment impairments. And we had a bunch of equipment associated with Intel 7. And a lot of that was driven by the COVID era PC expectations. And now as we moved on to our future process technologies, Intel 3, Intel 18A, that's all based on an EUV or a next generation equipment base. So we had a charge or an impairment associated with those prior, and that affected our earnings or the published views of those.
What do you think, Pat, some of the biggest challenges you have left to furthering your initiative in the foundry business?
Well, we have to finish what we started. And even as we see the end of our 5 nodes in 4 years, this historic pace of innovation, we have to get it done. We have to ramp 18A into high volume manufacturing for both Intel products as well as our foundry customers as well. As we said on the call, the Arizona factory will be the first high volume factory for 18A. So that's a super important, and that comes online in the second half of next year. So I'll say great milestone this quarter, but we have a lot of work to get done yet to finish what we started in 25.
Where do you think you're at in the turn? Are you past the low point in 2025? You're back to growing revenue, margins are stabilizing?
This was a critical quarter for Intel. The major restructuring efforts that we've largely finished this quarter, we'll say the second phase of the transformation as we move from getting back in the game, and we invested heavily in capacity and technology development and products that were competitive. Now it's time for us to focus on having the financial and shareholder returns associated with those heavy investments of the last 3.5 years. And that's what this next phase of the transformation is all about. And with that, those investments start to come to life. And for that, the good operational results that we saw for Q3 above expectations, the raise of guide for Q4, this was a critical quarter for us, and I think gives optimism for what is to come.
For the full interview with Intel CEO Patrick Gelsinger, please be sure to head over to our Yahoo Finance website. You can check out the full interview there. Let's keep the conversation going with Intel, the results that we got out last night. It looks like the street, at least, looking at those results favorably at first look. We want to bring in John Vinh. He's KeyBanc Capital Markets Equity Research Analyst. John, it's great to have you here on Yahoo Finance. Let's talk about what we heard from Intel last night. Lots of questions going into this print, whether or not Intel and Pat Gelsinger there at the helm was really going to prove that they are on the right track now. What do you think?
I think the results yesterday showed that things have at least kind of stabilized. Obviously, they previously announced a major restructuring. Looks like they're largely through that restructuring with kind of reducing its workforce by 15%. Demand across those PCs and server business has kind of stabilized. But I think there's a lot of questions that remain of whether these guys can get back to growth or not.
Is Gelsinger the right person for the job?
I think for the time being, he is. I think he's got a lot on his plate, and I think he's doing the best that he can do, just given the market dynamics that are out there.
With all of that in mind, I mean, the chip ramp and the fabrication of chips as well is where a lot of that spend had been prioritized, continues to be prioritized around. What are your new timeframes at which you'll be grading Intel based on to meet some of those marks that Wall Street and the investors are anticipating that Intel will need to do and implement in order to ultimately kind of stave off further competition and ultimately see that flow through to the financial performance over time?
Yeah, I think there's a couple things that we're looking for going into 2025, right? 18A is kind of the first node that Intel is potentially going to be, competitive with like a TSMC. It's going to start to ramp next year. They announced 3 new customers yesterday, including AWS. They've got roughly about 8 customers right now. Those schedules are on track to start ramping next year. So obviously we're going to look forward to them updating us in those milestones going forward. I think the second thing is they announced their AI initiatives are disappointing. They're going to fail to meet their Gaudi expectations of shipping $500 million in AI chips this year. That's pretty disappointing given that NVIDIA is going to do $100 billion this year. AMD is going to do $5 billion this year. So we've got to see, what their plan B is. They've got a next generation chip called Falcon Shores that should start ramping towards the end of next year. So those are really the two kind of major kind of next milestones that we're going to be watching closely.
And of course, John, as we look beyond the election, one of the big talking points or questions, I think, amongst investors, analysts, is really what the future looks like for Intel, whether it's a standalone company, whether or not we see outside interest from a name like Qualcomm. What do you think the likelihood of that is?
I know there's been some speculation that there's been some overtures for Intel. I think some of those potential overtures are probably for certain key assets of Intel. I don't think that a sale is likely. I think it's just, I think there's just too much kind of overhead for a lot of these other potential companies to want to take on at this point in time.
KeyBank Capital Markets Analyst John Vinh. John, always a pleasure to get some of your insights and perspective, especially on a major name like Intel. Appreciate it.
Thank you.
Coming up, everyone, we've got Acting Labor Secretary Julie Su, who's reacting to the October jobs report. That on the other side.
Welcome back to Yahoo Finance Live from the Labor Department here in Washington, D.C. I'm Jennifer Schonberger. The jobs report coming in much weaker than expected on that top line payroll number. Only 12,000 jobs added in the month of October, buffeted by 2 hurricanes and the Boeing strike, but the unemployment rate holding steady at 4.1%. For more insight on what just happened over the past month, I want to welcome into the program Acting Labor Secretary Julie Su. Secretary Su, thanks so much for joining me. It's always great to see you.
You too.
So the report says that the establishment survey was impacted by the hurricane, but that the collection period, the fact that it was shorter, only 10 days versus as long as 16 days, was a bigger impact. I know it's difficult to parse, but it says collection rates were similar in storm-affected areas versus non-affected areas. So how much of this report is due to the hurricane activity versus actual outright weakness in the job market?
Right. The job market is not weak. You know, for months now, we've talked about the steady job growth. You know, we have seen GDP is still up, inflation is down, real wages are up, the unemployment rate remains steady, as you reported. The reporting issue, the simplest way to describe it is that this was a short reporting period because we're here talking about this on the first of the month. Sometimes it's it's almost a whole week later, and so overall, the picture of the labor market remains what we've been saying, right? A real job growth. You know, this administration has had positive job growth every single month that it's been here, and this doesn't happen by accident. Remember, 4 years ago, we were still living with the devastating effects of a global pandemic because national leaders did not take it seriously enough. And by contrast, in this administration, we have made historic investments in infrastructure, in manufacturing, in clean energy, in things that have helped to power the labor market and the 16 million jobs that have been created since January of 2021.
You mentioned the job market still remains strong. We look at the 3-month average growth trend, and that has actually softened significantly. 267,000 was the average back in January, 186,000 in September. Today, with the downward revisions that we saw for the past couple months, and today's number, the 3-month average comes to just 104,000 thereabouts. So is job growth decelerating, and do you expect this trend to continue?
So let's remember, for much of 2022 and some of 2023, the jobs numbers were really high, over 400,000 a month. That was part of the really rapid recovery that we wanted to see coming out of COVID, coming out of the economic impacts, the economy that we inherited in 2021. And since that time, the job market has been stabilizing, and the 3-month average, if you discount this last month, which we can talk about the anomalies that led to it, but the 3-month average for the prior 3 months, even with revisions, is 148,000. That is steady, stable job growth. That's the kind of labor market that most people would be talking about in any other time as being very solid. And again, the unemployment rate has been at, near, or below 4% for the longest stretch of the 1960s. I've said that again and again, but it's a really important factor when you talk about the strength of the economy. And GDP growth is up, right? So we are seeing continued real steadiness and stability. And this last month was impacted by, as you mentioned, there were hurricanes that were devastating. They devastated back-to-back hurricanes that devastated southeastern states that people lost their lives, people lost their homes, their businesses. And when you talk about the jobs numbers, imagine a business, right, in North Carolina that would have been otherwise hiring, maybe even ramping up for the holidays. Of course, they didn't do that this last month.
To your point, the unemployment rate held steady at 4.1%. We know that's a separate survey from the establishment survey. It's a household survey. So does that imply that, to your point, this was more short-term job losses? Should we be taking more signal from the unemployment rate versus the payroll numbers?
I mean, there's no question. This last month, the numbers were affected by the devastation of the hurricanes. They were also affected because there were over 30,000 workers who were on strike. And so I expect that we'll be coming back here next month talking about the resilience and the strength of this labor market.
Manufacturing jobs down by 46,000 last month on account of strike activity. I know that you helped break the latest deadlock on the Boeing labor dispute. They're set to vote on a third plan now on Monday, November 4th. What are your expectations? Do you think this third time will be the charm and this will clinch the end of this strike?
So look, we've seen time and time again under the most pro-worker, pro-union administration this country has ever seen, right, under President Biden and Vice President Harris's leadership, where we've said from day one, when you build an economy that's good for working people, it's better for business, it's good for our economy, it makes for a strong country. That is the story, that is the picture of our economy. And in the strike you're talking about, these are workers who have not had a real wage increase for over a decade. And now, because they have a union, they had a chance chance to come to the bargaining table and say, this is what we need. This is a good, decent, honest living, and we want to make sure that it
Do you
remains
think you got
one.
it done this time?
Well, look, I'm not going to predict how workers will vote. At the end of the day, they have the power to decide whether a contract is fair. That's, again, part of the beauty of the collective bargaining process. But they got historic wage increases like they have not seen in over a decade, really ever. Health benefits, retirement security. These are all really basic things, that we'd want in every job. Not every worker has that. And when you have a union, you're more likely to have it. And when you get to bargain for it, you're more likely to win it.
Before I let you go, I want to ask you about the labor force participation rate, because we saw that drop by a hair to 62.6% from 62.7%. Was that owed to the hurricane?
It's hard to be that specific in terms of what it's owed to. Overall, I would say, again, the labor force participation rate remains incredibly high, right? So we are parsing numbers from one month to another that, when you look at the trends and we look at the overall picture, these are, people are in the labor market, both men and women, in numbers that we haven't seen for a very long time. They're stronger than the pre-pandemic period. And we need to continue to do the things that we've been doing that are working, right? Investing in communities, fixing roads and bridges, creating good union jobs as a result of that. We need to continue to build up, healthcare and care. And we want everybody who wants a job to be able to find a good job in their community. That's been our focus. And we'll keep on doing the work to make sure that happens.
All right, well, Secretary Sue, we'll have to leave the conversation there, but thank you so much, as always, for your insight.
Thank you.
That's Acting Labor Secretary Julie Su, she tried to say. We'll leave it there. We'll be right back after this.
All right, Jen, I'll take it from here. Thanks so much. Appreciate it. Great conversation there. Before we go to a break, let's get a quick check on the markets right now. The U.S. major averages up across the board right now. The Dow Jones Industrial Average up 0.8%, as is the S&P 500. The Nasdaq Composite up by about 1% right now.
That does it today for Morning Brief, but join me coming up next hour. We've got much more analysis on the biggest drivers here this morning following that weaker than expected jobs number out before the bell. More analysis coming up on Catalysts. Welcome to Catalyst. I'm Shauna Smith. We're 30 minutes into the U.S. trading day. Let's get to the 3 catalysts that we're watching this hour. First up, full coverage of big tech earnings and a look at the winners and losers in the race for AI dominance. Plus, we break down the surprise October payrolls report and what it means for the Fed's rate path forward. And a look at the state of the manufacturing in the U.S. as the sector loses jobs in October and as ISM manufacturing data crosses the wire this hour. Apple's fiscal fourth quarter results topping Wall Street expectations across the top and bottom lines. iPhone sales rising 5.5% from a year ago during the period. A welcome reacceleration after 2 quarters of sluggish growth. Now, Tom Forte, he's Maxim Group's managing director and senior consumer internet analyst, joining us now. It's great to have you here, Tom. Let's talk about the reaction that we're seeing in shares here, off just about 0.7%, so off the lows of the morning. Yet this move lower, I want to point out, coming despite the fact that we did see pretty strong demand or stronger than expected demand for iPhone sales. Is this all about guidance, or what do you think the street is focused on this morning?
Yeah, so I think that it looks to be a very slow developing super cycle for AI-inspired upgrades for the iPhone. And the reason I say that is they had 5.5% growth in iPhone revenue in the September quarter, and they're guiding to total company revenue growth of low single digit. So I think the 2 noise points in the data are that China macroeconomic weakness, China's about 15% of revenue. I think that's making it hard to determine if we're seeing a super cycle. And the other is that there was a mismatch in the timing. They had the new iPhone hardware out in September, but they didn't have the new AI software until more recently. So I think there's a lot of noise in the data on whether or not we're actually, in fact, seeing a super cycle. And I think that's what's weighing on shares.
Yeah, Tom, I want to dig into both of those points. Let's first start with China, some of that weakness there. Are you optimistic about the recovery that we could see here in the coming quarters?
The challenge for Apple when it comes to China is that it's possible Apple Intelligence will never make it there when you think about the government restrictions and things of that nature. The company so far has said that we know it's rolled out in the US today. They intend to add it to more English-speaking countries, and it isn't clear if they're going to have it in China, when they're going to have it in China. So I think that's going to be a challenge for Apple.
And then when you talk about the upcoming rollout here, or the, I guess, ongoing rollout that we're getting of Apple Intelligence, obviously maybe a bit of a slower start than what the street had initially forecasted or wanted to see here. Is it going to be enough here in order to act as a catalyst as you look ahead to 2025?
The challenge for Apple always is consumers are trained that essentially every fall a new iPhone device is launched. So the question is, will consumers wait for Apple Intelligence, or will they wait to buy the phone next year? And I think that's a real risk for Apple.
Tom, one of the things that I've noticed in some of your colleagues' research notes this morning, they were talking about the incoming or the transition that's underway for Apple's CFO and whether or not maybe Apple is intentionally setting the bar low this quarter when it comes to guidance, just given the fact that they have a new CFO in that role. Are you at all, do you share that view, or I guess should we be reading into this weaker than expected guidance at all?
That's an interesting point. I don't share the view. I think when you look at Luca Maestri's tenure and you compare with Peter Oppenheimer, they always essentially beat when Peter was there, but Peter had the advantage of a much greater amount of visibility than Luca had. When you think about Luca was the CFO during the pandemic, things of that nature. But no, I don't think they're lowering the bar for the new CFO. I think that they're basically saying either that services should be strong in December, iPhone should be similar to what it was in September, in the December quarter, and then everything else is going to be weak. But no, I don't think they're lowering the bar.
When it comes to services, a little weaker than anticipated, how worrisome is that to you?
Well, I think, all right, so you talked about essentially shares being flat despite all these concerns we're talking about. And our hold is based on valuation with, the stock trading at nearly a 30 times PE and 5%, 6% EPS growth longer term. But I think that if there's a silver lining in the Apple story, it's that the services revenue is essentially the highest margin revenue, and it looks like it's growing still the fastest. So I think that can, so for us, we maintained our EPS estimate for fiscal 26 on stronger gross margin, on stronger services revenue relative to everything else. So I think the services story seems to be intact, which is great for the stock.
So when you consider just the future direction here of Apple, despite some of these concerns, like you're saying, there is still reason to be optimistic. Has there been too much made of where Apple stands in AI adoption and the fact that they were a little bit slower than maybe many would have liked to see in the AI rollout?
I would say no, to the extent that we've done analysis before, and you looked at the very big upgrade cycle from 5G, and we kind of compare and contrast what AI could be versus that. The start is very slow, and it suggests to us that they're going to get less than half the benefit they got from 5G. So I think investors are legitimately concerned about that. As the company's still over-dependent on the iPhone, it represents nearly half their total revenue.
Tom, what's your top pick in the space? Where does Apple fall?
So I still much prefer Amazon. And the reason I prefer Amazon is because I think they can exploit artificial intelligence in a way that others can't. They have the cloud computing business, so they're selling the promise of AI to enterprises. And then artificial intelligence improves their retail sales and their labor costs at the fulfillment center to the extent they increase automation. So I much prefer Amazon to Apple right now.
And Tom, when you take a look at just the overall spending that we've seen in sheer volume, you talk about Amazon, just the comments that we heard from Jassy, this once-in-a-lifetime opportunity when it comes to spending on AI, it certainly puts the pressure or maybe perspective here further in focus for investors just about the importance of some of these AI names. Are they still going to be one of the driving factors, do you think, of the broader market then when you look ahead to some of that opportunity in 2025?
What I've greatly appreciated were June quarter earnings and September quarter earnings. Investors are trying to figure out what is the near term, meaning 12 to 18 month impact to sales and profits from artificial intelligence. It's clearly different for NVIDIA, for Amazon than it is for Apple, for others. And I think that's a very good discernment being made by the market. So I don't expect AI to continue to drive the market over the next 12 to 18 months.
All right, Tom Forte, Maxim Group's Managing Director and Senior Consumer Internet Analyst. Thanks so much for taking the time to join us.
Thanks, Shauna.
Well, this quarter marking another earnings season dominated once again by AI enthusiasm, but the staggering CapEx spend some names have announced have been met with some skepticism by the street. With more on artificial intelligence and the Mag 7 where things stand, we want to bring in Nina Schick. She is an author, speaker, and strategic advisor who works with leaders to explore and harness the exponential potential of artificial intelligence. Nina, a lot to unpack here. Let's just start with the sheer volume that we're seeing in CapEx spending by some of these big tech companies. When you take a look at the fact it's on track to surpass $200 billion this year, rising even further ahead into 2025. Just where does that tell us about where we are in this cycle and what that potential growth looks like for years to come?
Well, I think we're still very early in the cycle, but I think the fundamental point here is that we really are moving towards a platform shift in the sense that we are moving from the age of information to the age of intelligence. And if we really are to bring to light some of these kind of capabilities that have been promised by artificial intelligence, well, guess what? It requires a lot of big infrastructure spend. And that is what we're saying. You mentioned 200 billion, but by 2028, it's projected that we're looking at, upward of 600 billion. And if we're spending this much money, and if you look at the CapEx, it's historically unprecedented. If you look at any moment of great exponential technologies that have kind of transformed society and the economy, we never have seen this amount of spend. So that to me suggests, and by the way, I'm a huge proponent of what's possible with artificial intelligence. It suggests to me that we're only at the very beginning and that these capabilities, in order to really kind of bring them to light, well, we need to do a lot more spending in the infrastructure. And that's what we see happening right now.
Nina, among the big tech giants, who is best positioned in your view at this point?
Well, I think what's been really fascinating amongst the big tech giants is that there has been a huge competition unleashed, especially since that kind of bottled lightning moment of ChatGPT coming out, because that's really when we started to understand, right, that some of the theoretical promise of AI was moving to the realm of reality. And over the past 24 months, there's been so much competition. And I think each of them is really trying to dominate. And again, I think it comes now to who is placing their bets well in the infrastructure. And when I talk about infrastructure, it's really the things like data centers, semiconductors and computational power, and who has access to energy resources. So it's been fascinating to see how just in the past month, all of the hyperscalers are not only investing kind of in the frontier platforms, but are investing increasingly in data centers, are trying to line up to make sure that they have their computational hardware needs met, and also beginning to sign deals with nuclear providers, because the kind of current energy grid simply doesn't support the capabilities of what's needed if we want to take AI to the next level.
Yeah, Nina, you advise the government, also a number of those within the private sector. I guess just how realistic are some of these lofty expectations given the amount of growth that we have to see within infrastructure in order to meet those goals?
So I think that it's not only possible, but I think it's inevitable. I have been working in this field for the past 10, 15 years, and the predominant observation perhaps is how much faster than anyone expected the kind of capabilities are advancing in terms of what AI can do. But now I think that is really augmented by the fact that you have unleashed such a huge global competition. And it's worth remarking that kind of the Magnificent Seven who we're talking about today have been leading that, because in order to really build that infrastructure to take this to the next kind of level of evolution, like I mentioned, you need to really spend a lot of money in the infrastructure. And like we've already discussed, the amounts that we're talking about are truly unprecedented and historic. So I think, we're only in the very, very early stage of what's possible. The kind of CapEx that's been unleashed now, I expect to see those figures going up even further. And we're already starting to see kind of real world value, which I think is only going to be augmented and amplified, especially when we start getting from moving away from kind of training models to inference and real life use cases.
Nina, real quick before we let you go, OpenAI's ChatGPT here launching a search feature. Two parts of this question. One, how successful do you think this is going to be? And then more specifically, does this potentially pose a threat to Google?
So this kind of argument about this being an existential risk to Google has been around ever since ChatGPT came out. I think that if you look at the frontier models, you see a lot of competition, from Anthropic, from Perplexity, but I think that ChatGPT still kind of is the best large language model that's out there. And of course, instinctively, this absolutely makes sense, right? This is a new way to find information. No wonder then that you see Google very rapidly amping up its capabilities with its own kind of frontier models. I'm talking about the Gemini body of large language models. So I think that whatever happens, we might not see the dominance of one large language model or one multimodal per se, but the fundamental point is that the way that we interact with search is definitely going to change. And perhaps you already do what I do, and that is now, I already use a large language model on my phone, on my desktop to find information. So I don't necessarily go to Google search anymore because it's just not simply the most efficient way.
All right, Nina, thanks so much for joining us here this morning to help us kick off Catalyst. Coming up, we are just days away from the FOMC's November meeting. What the October jobs report means for the upcoming rate decision next.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
The U.S. economy adding far fewer jobs than expected in October, while the unemployment rate did hold steady. Here with what all this means for the Fed, we want to bring in our very own Yahoo Finance's Jennifer Schomburger. Hey, Jennifer.
Good morning, Shauna. That's right. Payroll is coming in much weaker than expected. Only 12,000 jobs added in the month of October, buffeted by 2 hurricanes and that Boeing strike. Manufacturing jobs dropping by 46,000 on account of that Boeing strike. But aside from the hurricanes, it may have been a shorter collection period, a shorter survey period of just 10 days versus the typical 16 days that weighed more heavily on this jobs report. Take a listen to what Acting Labor Secretary Julie Su just told me moments ago.
The reporting issue, the simplest way to describe it is that this was a short reporting period because we're here talking about this on the first of the month. Sometimes it's it's almost a whole week later. And so overall, the picture of the labor market remains what we've been saying, right? A real job growth. This administration has had positive job growth every single month.
The unemployment rate held steady at 4.1%, and perhaps that may tell a truer story of the job market. The payroll numbers are based on a survey taken by employers, which is why we saw such a drop there. On the other hand, the unemployment rate is done by a survey on households, suggesting that the payroll number was due more to short-term job losses. And indeed, Acting Labor Secretary Julie Su told me she expects jobs to rebound next month. So what does all of this mean for the Federal Reserve? This was clearly a messy report. The Fed is likely to look through this. My sense is that Jay Powell woke up this morning and looked at this report and said, yep, we're cutting by 25 basis points. There will be some hawks on the committee that are concerned about persistent core inflation based on the Fed's preferred inflation gauge that we got yesterday, core PCE. So perhaps the compromise is they cut by 25 basis points next week and then chart a course for a more gradual path. Guys.
All right, Jennifer, makes sense to me. We'll see what happens here next week at the meeting. Taking a look at Treasuries, seeing just a slight sell-off here this morning on the back of some manufacturing data from S&P and ISM. Joining us now, we want to bring in PGIM's fixed income chief U.S. economist, Tom Porcelli. Tom, it's great to have you back on the program. So we got some manufacturing data out this morning. Of course, we also had the jobs data, and it looks like at least the reaction initially to the jobs data might be more of a knee-jerk reaction than anything that we should be considering beyond that. What do you think?
Yeah, I mean, if I look at 2-year yields, the initial reaction was they fell, more than 10 basis points. They've taken some of that back. So now it looks like we're maybe 7 basis points lower than where we went in. I think that's the right reaction. I mean, look, I think on the margin, this was a softer report. And I'm not talking about the, sort of the plus 12,000 that we got. I mean things beyond that, because I think we all appreciate the plus 12 was really impacted by hurricanes and strikes and et cetera. But I think when you sort of look at the fact that there were pretty sizable downward revisions to the prior month of 112,000. When you look at the unemployment rate, that actually almost rounded up to 4.2%. And was sort of capped out. There was a ceiling on the unemployment rate because the part rate fell. I mean, I think these sort of softer undertones to me are really consistent with how the market is sort of priced today, which again is to say a little bit lower from a yield perspective.
What does it also tell us just about how much is riding on the election and the outcome and what that ultimately means for the bond market?
Yeah, I mean, look, there's no question that there's a lot of uncertainty around next week. I mean, next week is, to say it's going to be a busy week is probably an understatement, because it's not just the election. We also have an FOMC meeting. And, we're going to wait to hear about the tone that Powell's going to set with regard to, what comes next. So, yeah, I think there's quite a lot. Look, the reality on the election is I think we just sort of need to wait and see what the overall outcome is going to be, because no matter who wins, if they have a split Congress, it's going to be really hard to get a lot of any of the plans that you're talking about done. But one thing I think is pretty clear with either candidate is you're probably looking at continued deterioration in the deficit, right? I mean, I would argue no matter what the outcome, they're going to have to address the Trump tax cuts. And I think it's going to be really hard for either of the candidates, no matter who wins, to just let them expire. So I think some further deterioration on the deficit at a minimum is the right way of thinking about it.
Tom, what do you think the likely range is that we're going to see? Lots to talk about 4.2 to 4.3, whether or not we could actually push back above those levels. What do you see on the horizon?
You mean for 10-year yields?
Yes.
Yeah. I mean, look, here we are at 430 right now on 10s. I mean, the way that I think we can always overcomplicate these things. So let me try to really make it very simple for folks. If you think about sort of the thing that really should be a key driver of 10-year yields, it really should be what you think Fed funds will average over the next 10 years, right? I mean, again, we can complicate it as much as we want, but I think that's a very fair starting point for the conversation. I mean, you could build in term premia and et cetera. But I'm saying that as a starting point, that's the right way of thinking about it. And when I think about that in those terms, 430 on 10 seems about right. Now, again, doesn't mean you're going to be pinned there. In fact, what I would say is drop a pin at 430 and draw, sort of a circle 25 or 50 basis points on either side. And now for some folks that might say, oh, that's a really wide range. Yeah, it is a really wide range. I mean, I think that that's probably where you're going to drift in and out of. So I think as a starting point for the 10-year yield conversation, 430 is pretty fair to me.
And Tom, just given all that uncertainty and what has played out here over the last several months, I know this next question might be a bit tough to gauge at this point, but how does all this factor in to your outlook then for 2025, given that uncertainty and given the level of activity that we've seen play out?
Yeah, so I love this question because I think it gives us an opportunity to really sort of give everyone a sort of snapshot in time. How are things looking from an economic perspective? And economically, we're looking pretty good in the United States. I mean, that's a full stop idea. We had some really sizable income revisions about a month ago that really drove home that the consumer from a balance sheet perspective is in pretty good shape in the aggregate. I mean, there's obviously going to be pockets of weakness. But on balance, I think that this is an economy that can easily sort of run around trend growth. I think it probably comes in a little slightly less than that, call it 1.5 to 2%. But again, you would sign up for that any day. So I think snapshot in time today and how I see things unfolding, again, X the election, I think that things are looking pretty decent in the United States. But of course, you're going to have to layer in sort of election impacts. But again, from where the starting point is actually pretty good.
So Tom, then for investors looking to put some money to work trying to figure out what the best portfolio plays are right now in fixed income, given that outlook, what would your advice be?
Yeah, so I don't even know if I'm allowed to give advice about investments.
Maybe more broadly speaking than Tom.
Yeah, exactly. So what I would say is this. I think if you think about sort of the Fed and what the Fed has teed up, I think the Fed is going to continue to cut rates. Now it's just, I think what recent data, what recent sort of decent data have done, obviously this payroll report notwithstanding, is really sort of take a lot of the urgency away from the Fed's sort of desire to get to sort of some semblance of neutral. So I think as long as the Fed continues to cut, which is what we expect, I think in a more modest way over the coming year. I think what that means is that, you're probably looking at 10-year yields that really don't move all of that much, again, within that sort of broader context of what I was highlighting. It's obviously going to be variable. But I think what that does is allows the curve to steepen out. So I think front-end rates will drift lower with, sort of 10s that are going to be sort of, again, I don't want to say pinned, because they're not, they're going to move around. But, roughly at fair value now, I think that allows the curve to steepen out.
Exactly what I was looking for there, Tom. Tom Porcelli, thanks so much for taking the time to join us here this morning.
Of course, thank you.
Coming up, a look at some of the best and worst performing stocks on Yahoo Finance's trending tickers page. That's when we return on Catalysts.
I run this place with my husband.
Talea is the only female-founded brewery in New York City.
We opened our first location 1 week before the pandemic.
The market changes quickly, the landscape changes quickly.
What we didn't have was money or investors.
So we turned to crowdfunding.
Every incremental sale that we make is a new door we're opening.
We were able to raise about $30,000.
You have to be able to persevere and take the leap.
The plan is to get to 100 locations.
We are here to expand the craft beer market.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session with Yahoo Finance's trending tickers page. Got Ali Canal here to break it down for us. So let's kick it off with 3 stocks that we're watching. That first one being Coinbase here, Ali. Coinbase shares sliding. The crypto exchange platform's guidance and third quarter earnings both missing the street's expectations. Trading volume remaining mostly stagnant. We were looking at massive losses yesterday. You're seeing a bit of a rebound here today off those lows, up just about 6%. But I think the big question going forward is what ultimately this growth is going to look like. Of course, not really a huge surprise that we are seeing a bounce off the lows, but I think the action yesterday just really illustrates some of the trepidation and concern here from the street, at least in the short term.
Yeah, look, several key misses here, and we have to keep in mind that yesterday we saw a huge sell-off in tech and across the broader markets as well, so that pressured shares along with these disappointing earnings. This is also a company that's really closely tied to the price of Bitcoin, and we have seen Bitcoin hovering near record highs above $70,000 a token. It's been on this steady upward trajectory. It's up more than 65% year to date, 15% just over the last month. And depending on what happens next week with the election, we could see prices increase even further, which would be a positive catalyst for the revenue story at Coinbase for the fourth quarter and beyond. In the release, the company actually called out the election as, quote, the next major milestone in our ongoing work to drive regulatory clarity for crypto. Trump has been a huge advocate for crypto. Harris has also signaled her support. So given all of that, analysts seem pretty bullish on the outlook here. Sentiment seems to be strong. We have 15 buys on the street, 14 holds, and just 3 sells.
Yeah, and I think going forward, also just maybe one of the questions here, and Dan Dolev wrote about that from Mizuho in his most recent report, was just some of the questions that maybe this brings up about their competitive mode and what exactly Coinbase's position is in regards to some of their other competitors on the street. Let's talk about Comcast, a stock that you follow very closely here. The media giant considering spinning off its cable network into a separate company. Comcast saying that the potential spinoff would, quote, create a new, well-capitalized company owned by our shareholders. You're looking at some slight gains of just about 0.6%. Ali, my question to you, and we could talk about this report here from the Journal, but my question to you, this doesn't necessarily come as a surprise, just given the activity that we've seen, right?
It doesn't really surprise me. Now, this would only include the cable properties, so think Bravo, CNBC, USA Network. It would not include the streaming offering, Peacock, or the broadcast network, NBC. And we've seen disruption across the entire traditional television sector. More consumers cutting the cord across the industry. This scramble to survive as Netflix has really emerged as the winner of the streaming wars. But where does that leave everyone else? And that's the big question. And with a company like Comcast that has so many properties under its umbrella, this is a move for them to really focus on what's working and protect what's working. And for them, that's their broadband users along with streaming. Now, in the quarter, we did see cable subscribers fall by another 365,000 to just 12.83 million. And it's something that we've seen echoed throughout the entire industry. We saw write-downs in cable businesses from Paramount and Warner Brothers Discovery. So again, not totally surprising here. That being said, though, this would be a very complicated move, right? Like, how do you separate CNBC from the network NBC? It's still very early days. On the earnings call, Mike Cavanaugh, he's the president of Comcast, he said he really just wanted to come to Wall Street early with this, be as transparent as possible. There's exploring it, they're studying it. We don't know what this
Are analysts
mean.
in favor of it, or are they seeing an opportunity there?
They say that they could potentially sell this off, potentially.
Right.
And Bank of America was out with a note saying that a spin out could be a cable network consolidator, that we could see this kind of be repeated by other players in this space. Again, strategic review, no timing has been revealed yet. And again, not including the broadcast network or Peacock. So a lot of question marks, but I think this is something that we're just going to be hearing more and more of. And I'm curious when we get earnings from Paramount and Warner Brothers Discovery next week if they're going to comment on that at all. Because I'm sure it'll be brought up on the call.
Yeah, that is a great point. And also just given the write-downs that we saw, the cable side of their business as well. Was it last quarter?
Yeah,
last couple quarters, yeah. All right, finally, we're taking a look at Wayfair here. Shares are rallying this after the furniture company's third quarter adjusted earnings per share blew past the street's expectations. They had been rallying, but we're now looking at losses here, just about 2%. The reason why? Muted guidance coming out of the earnings call. That was enough to reverse that reaction that we initially saw with shares popping just about 8% here in the pre-market. Here we are just about an hour into the trading day. Certainly a different outlook. And again, when you take a look at the fact that the consumer is under pressure, this muted guidance here, something that the street is really taking issue with.
Yeah, the company projecting revenue will decline by a low single-digit % in the quarter. So that disappointment really taking the wind out of the sails of what was an otherwise okay report. Earnings and revenue Revenue was down 2% year over year, but we did see that improved profitability, which is encouraging in the face of a more challenged industry overall. So better than feared print seems to be what this was. The stock, though, it's just struggled. It's down more than 25% over the past month, more than 30% since the start of the year. It's a heavily shorted name. Digging through some of the analyst commentary, again, generally positive on the report, but the outlook and the way forward here, I think it's a big question mark for a company like Wayfair. And I mean, personally, like, I've ordered stuff from there. It is impossible to put these things together.
It's impossible to put together the customer, relations. The one order I had not too long ago was a little tough to work through. Once you have it, they want you to contact the manufacturer instead of going through them. Adds a whole layer of complexity. But again, though, you can make the argument that in this macro environment, people do tend to steer towards deals. And sometimes Wayfair, obviously, you can get
the competition, though. I mean, Amazon, you can find a lot of that stuff too. So we'll see where this company shakes out.
We will see. All right, Allie, thanks so much for joining me here today. All right, coming up, we got U.S. factory activity weakening further in October. The chairman of the ISM Manufacturing Business Survey Committee joining me next, coming up to break down the data. We'll be right back.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
ISM manufacturing data out earlier this morning, coming in below expectations at 46.5, under the average estimate of 47.6, its sharpest contraction this year. The data showing further signs of weakening as the election and Fed policy spook businesses. Joining us now to break it all down, we want to bring in Tim Fiore, chairman of the ISM Manufacturing Business Survey Committee. Tim, it's great to have you here. So when you take a look at these numbers, manufacturing sector now contracting in October for the 7th month in a row. I'm curious just to get your reaction and what you're hearing from business owners.
Okay, thanks, Shauna. So that's 7 months. 7 months ago, we had a PMI of about 50.3. So if you really look at it, we're 26 months into a contracting manufacturing environment, primarily driven by the new order levels of demand being non-existent for 26 months. Our backlogs at 25-month contracting declines. So we don't have an order book anymore. The order book has all been used up. The soft landing has allowed us to consume all that excess ordering and excess inventory over the last couple of years, but we're waiting for demand to come back. As a result of demand not coming back, we're taking steps on the output side, which is really defined as production and employment. And as you can see, that's really the story for the month, is that our production number, which is really a surrogate for revenue, is down to 46.2, lowest level in several years. Not a huge surprise. We've been projecting this now since May. The extent of the number is a little bit surprising, but not totally surprising. You also have the hurricane factor in there. So we're in a destaffing, declining output environment here, and we think we'll stay there probably until sometime in Q1 of next year.
Yeah, Tim, I was going to ask how long you see that being the case. I guess given some of that weakness that you have seen, how much of this has to do with uncertainty surrounding the election?
Well, a lot. So leading up to the Fed announcing that they're on the rate reduction profile, the single biggest issue was what's happening with rates. We're waiting for rates. I mean, we've been waiting for rate reductions since back in March and April of this year. And as we started 24, that was the belief that we would see rate reductions happening in Q1. So it's now Q4, and we're seeing those. But at the time that they finally announced that we're on a declining environment for rates, the election was right on us. And right now, the feeling is from the community, and this came through pretty strong in the comments, is that both candidates are proposing inflationary fiscal policies, which is going to make the Federal Reserve's monetary policies much harder to implement. So in other words, the Federal Reserve, Jay Powell, is going to be wrestling with the tiger all the way through the first half of next year. And there's a bit of uncertainty there. So I think we've been saying that we're not going to see demand come back until Q1 of next year. It may not be until February, March, when whoever the winner is has announced their implementation plans. And if we have a divided Congress, is going to make a huge difference. So a lot of uncertainty still here. We're going to have to wait to see what happens in Q1, I think. The election will be a big indicator, but honestly, with the tariff policies on one and tax cuts, and then you have the spending policies and the green energy issues on the other, both of them are inflationary, and it's going to be hard to keep that 2% PCE core target at where the Fed wants it to be.
So Tim, that's interesting, and then I guess marrying that with what you were just saying, just in terms of it won't be until Q1 until we start to see any sort of improvement. It doesn't sound like we're going to see much improvement then.
Well, I think this grow out is going to be slow. If it's not slow, it's going to be inflationary. So there's no reason why it wouldn't be slow. There's no reason why that after post-pandemic we've cleared all that mess and all those first-time events and record-setting declines and record-setting growth. We should be back in a normal supply-demand environment here, and there shouldn't be a lot of pent-up demand. That should all have been kind of satisfied. So we should be on a 1.7 to 2.0 GDP growth profile. So, and that will look a lot like what we saw back in 2016 through 2019, which was a slow but steady, and then it started to accelerate a little bit after the Tax Cuts and Jobs Act had some impact. And so there's no real reason why this is going to be a 3 or 4% growth. I mean, we should be back on our 2% profile. And as a result, we're going to see probably most of 2025 seeing a 52 to 55 PMI number. I don't see why we wouldn't, unless global issues like a huge investment in infrastructure for defense equipment and all that comes to play. I don't see why we would have a hot grow out period.
Tim, looking at the 5 sectors or 5 manufacturing industries that did report growth, among them you had apparel, you had food and beverage, you also had computer and electronic products. What are you hearing from those businesses, community, just in terms of the overall environment? And do they expect maybe some of that strength, if you want to call that, or at least some of that growth that we have seen. Can that continue in this uncertain environment?
Sure. So two of those are in our big six. The big six industry sectors represent 73% of manufacturing GDP output. So I focus a lot on the big six. Food and beverage is our number one big six performer for the last 3 months, but it's a seasonal area, and we seasonally adjust at the top level. We don't do it at the industry level. So I would expect, and if you look at the profiles over the last few years, food and beverage starts to fall off in November. So I think the food and beverage support is going to fall off in November. What's going to replace it? Well, computer electronics is expanding, but it's not expanding really strongly. There's a belief that some of that could be AI, maybe. Some of that could be a PC refresh cycle, probably. But again, it's not expanding at a 56 or 57 on its own merit. It's expanding at a 52, 53. So what we really need is we need transportation equipment to come back. That's contracting at a low 40 level, which is dangerous. That's automotive, it's aerospace, it's rail, truck, boats. So, and right now the automotive is the biggest headwind because of the huge amount of inventory and the pricing versus affordability versus leasing / interest rate activity that we're trying to fight through, and we will. With Boeing, hopefully the Boeing strike will end on Monday or Tuesday, and that'll clear up Boeing so that a year and a half from now, hopefully they'll be performing at a much higher level. But that's kind of where we're at. Food and beverage is holding us up. It's not going to hold us up for long. Computer electronics is helping for sure. That's a good thing. It's number 4 of the big six. But we really need transportation equipment to come back. And on top of that, chemicals is our number 1 industry sector, about 19% of manufacturing GDP. And we've been contracting on a pretty steady profile. It's also a feeder industry sector that supports the other 17. So when you see chemicals kind of turn around and get back up to 50 at 52, then the other industries are actually performing better. So that's a complicated answer, but that's kind of where we're at. Samantha, food and beverage, good, not for long. Computer electronics will probably stay at a fairly low expansion level. We need transportation equipment to come back, probably not until Q1. And our chemical area and our fabricated metal products, both in the big six, are still contracting. And those are feeders for the other 17. And we were not expecting those to really start to expand again until Q1 of next year.
All right, Tim Fiore, it's great to have you, especially on a day like today. Thanks so much for taking the time to join us.
Thanks, Samantha.
Coming up, we will be joined by the CEO of software company Gen to discuss the state of cybersecurity. Vincent Paulette joins us next on Catalysts. Shares of cybersecurity company Gen hit a 52-week high earlier this week, revising its full-year sales outlook higher after a solid second fiscal quarter, thanks to robust demand for cybersecurity services. You're looking at a bit of a drop today, but again, that steady climb to the upside on that one-year chart on the screen. We want to bring in the CEO of Gen, Vincent Pilette. Vincent, it's great to have you back here on Yahoo Finance. Certainly, the street was very encouraged by some of the trends that you laid out here in your most recent earnings report. I was looking at a note here from RBC out this morning talking about consistent execution, while new customer growth did accelerate on both a quarter-over-quarter and year-over-year basis. Give us some insight just about the trends that you're seeing and what that spells out for current quarter growth.
Yes, and thanks for having me back on the show, Shana. So this quarter in Q2, we actually reach a record membership on our cyber safety platform, almost 40 million paid customers. We have hundreds of millions of users, but people understand that they need higher level of security. We've seen a rise in scams and breaches, which led to a very high demand for our identity theft protection services, which grew 8% in the quarter. And I think the effect of those breaches, your personal information being more and more exposed, we believe today that more than 1 American out of 3 is at risk of having the identity protections compromised because their data are sitting out there in the dark web. And I think that rise in awareness, in interest, and then ultimately in demand for identity protection services is what's happening here.
And Vincent, when you talk about the new customer growth, that really stuck out in the quarter-over-quarter gains, year-over-year gains. What do you think that could potentially look like, even just looking ahead beyond the next year to the next 3 to 5 years?
Well, I think we believe that the cyber safety market for consumers specifically is still massively underpenetrated. People believe that they have good hygiene or that an enterprise or services will protect them. But actually, for no fault of their own, their data can be sitting on the dark web, compromised by breaches happening somewhere in the world, leading then to high volume of personalized scams supported by AI. And I think the demand for protection services like insurance that give you a peace of mind that whatever happens in the digital world will not compromise your financials or your hard-earned assets, I think will be on the rise for the years to come.
Vincent, when you take a look at some of the trends, more broadly speaking, as we look ahead to next week, I know you had a recent report out talking about election modeling, what cybersecurity activity has looked like ahead of this election. How is it compared to what we've seen in the past? And maybe what does that tell us just about the importance of a firm like yours in terms of securing people's security here just for years to come?
Yeah, definitely. And especially at time of election, we've seen more than half of the Americans being targeted by scams related to the elections, whether it's a fake donation scams or just a poll scams that try to steal your personal data. We've seen a huge rise here. And I think we always advise consumers to be really, really cautious, not only having good hygiene, but having the right protection as they look at digital information on the web.
And who is being most targeted?
Well, it's about everybody, but what we've seen is actually a rise in the younger generations. We always think that protection is when you have more assets and you're a bit later in life or in your life cycle. But actually, a lot of young people click on links on polls, especially related to elections, and then give up their financial or their personal information, leading to potentially exposure from cyber criminals.
Vincent, to what extent has AI adoption really complicated the detection part of this, or more so the prevention part of these types of risks?
Actually, AI has both accelerated the threat and provided tools for better protection. So when you look at AI today, they can really stitch plenty of your personal information sitting out there in social medias, on the dark web, or somewhere else in the digital world, and at a high volume provide personalized scams that you really believe is something that you can relate to, all the way to deepfake, close to what you know. And at the same time, we use AI to better detect patterns, anomaly patterns, and really enable the consumers to detect those scams. We launched a year ago our Genie solution, which is basically an AI-powered anti-scam tool that now will be embedded in all of our platform and any one of our offering to enable consumers to detect those scams.
All right, Vincent, great to have you. Vincent Pilette, thank you so much for taking the time to join us here this morning. Let's do a quick check of the markets following the October jobs report. And about 90 minutes into the trading day, you're looking at right around the highs of the session now. The Dow up just about 1%. The S&P above 5750 here, up at nearly 1%, as well as the Nasdaq. Flipping over to the bond market, the action that we are seeing in yields was a bit of a knee-jerk reaction, at least initially, to the print. We are now looking at yields higher across the board. You got the 10-year yield now back above that 4.3 level. And flipping over finally to the dollar and what we are seeing there, you are seeing a bit of strength here, right above a 104. Again, a couple of key trades to keep your eye on here throughout today's trading session. Coming up, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. I'll see you on Monday. Have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the October jobs report showed growth, but way below expectations. Just 12,000 jobs added versus the 100,000 that was anticipated. We'll be joined on set by a LinkedIn career expert who will give you the tips on how to master an interview. And the Department of Transportation has a new policy that can get you an automatic refund for significant flight delays and cancellations. Good to know. Going into the holiday travel season, we'll get you the rule with Yahoo Finance's Rochelle Akufo. Plus, small businesses make up 99.9% of all U.S. companies. Well, guess what? We're going to explore the challenges that Americans face starting and running small businesses. And you'll get to watch the first episode of a 4-part series where Yahoo Finance explores the world of entrepreneurship. Our first stop, Talea Beer Co., the anti-beer bro brand founded by 2 New York City female entrepreneurs. Stay tuned for that. All that and much more coming up during this hour. But first, as we mentioned, only 12,000 jobs were created in October. That is the slowest pace since late 2020. Now, if you're in the market for a new job, it might feel crowded and difficult to land that gig that you've been looking for. To discuss how you can stand out from the pool of applicants, we've got Andrew McCaskill, who is a career expert at LinkedIn, joining us. Andrew, great to have you here with us in studio. Yes. So, I mean, I gotta sprint over to the desk for this one, because as we're thinking about the jobs market right now and the challenges that are facing employees who are trying to get into that new gig, how can they make sure that they are equipped going into the interview to put their best foot forward and hopefully get an offer on the other side?
Yeah, I mean, one of the things we talk to hiring managers about all the things that are happening right now, and there are a ton of mistakes that folks are making. I mean, a lot of it goes back to just the old school pre-COVID way of doing business. Number one, the number one reason why a lot of hiring managers say that they're not giving folks offers, people aren't showing up on time for interviews. Like, it's old school stuff, or they're not prepared for the interview.
Wait, time out. Just not showing up on time?
Not showing up on time.
The rule is 15 minutes, right? Get there 15 minutes before,
15 minutes before.
Okay.
If you're at Morehouse, they used to tell us that if you're on time, you're late. If you're early, you're on time, right? And so I think that those types of things matter. You also have to have a lot of enthusiasm. One of the things that hiring managers are saying is this is an incredibly competitive market. They're tired of people coming in and they're saying that they want a job, not this job, right? And so I think that that's one of the other things. If we learn nothing else from these job numbers, is that it is going to be incredibly competitive for the next couple of years. This is one of the most competitive job markets we've seen. So a lot of the old school things really, really matter. The other thing that you've got to think about too is that level of enthusiasm. You can't discount it. Right. Every point that you have to engage with a recruiter or a hiring manager, you need to be telling them, here's why I am right for this job, because I want to have an impact at your company in this role. People are also not sending the thank you note. The thank you note is not really about thanking them for their time.
Yeah.
I mean, it is, but it's really about you putting one last salvo out there saying, I want this job, and I can be great at this job. I would love for you to give me a shot at it.
I mean, we were trained in college, handwritten thank you notes, in fact.
Yeah.
And so as we're thinking about the people that might be out there looking for jobs, some are also just looking to make a pivot as well. So say it's a position that is outside of the realm that you build up a ton of experience for already, but this is an area that you're passionate about getting into. How can you convey that, hey, you may not meet all of the prerequisites and criteria, but hey, if you wanted to talk to me, there's a reason why I'm here and there's a reason why you're interested. And so let me tell you what I'm willing to learn and do once I get into this role.
The number one I think that you got to do is network. If you're looking to pivot to an industry outside of where you are, think about who do I know in that industry and who do I know who knows people who are in that industry. Start there. Have some conversations before you get into that interview process about the industry so that you get better at speaking the language. That is a good cue to folks that you've done a little bit of homework about the industry that you want to pivot to, and you get a chance to learn before you get into the interview. The second thing I would say is then it comes down to skills. Like, if you know that there's skills that are needed for work in that particular industry that you need to bone up on, do some micro learning, things like LinkedIn Learning or online courses or certifications to help you start to, one, speak the language of that industry and of those occupations. That will save you in so many ways. And then finally, AI is your friend. Like, don't run away from the machine, run with the machine. There are tons of AI tools that will help you write better emails to those folks, that'll help you sort of really hone in on your story that you want to talk about, to your pivot, and use those tools to also help you do better research and more accurate research, so that when you go into that conversation and you're talking about how you want to pivot, you're doing it in a way that says this person has invested time, effort, and energy in it. They have a passion for this, and they really can help me understand how the skills that they have over here will help them in these roles. You have so many skills that are transferable to other roles. Never forget, my last one on this is human skills matter.
Yeah.
Communication is the #1 most in-demand skill on LinkedIn right now, and it has been for 2 years in a row. And CEOs have said to us that they want adaptability in all of their hires. The world of work is changing so fast, so rapidly. 70% of executives said that they've never seen work change this fast.
Yeah.
And they want people who are adaptable, folks who are willing to pivot and not panic. That's who they want to hire.
Just elaborate on that a little bit more. What is the #1 communication skill that can help someone's case for getting a position or that they can brush up on in order to best position themselves for a next position as well?
You got to be able to write.
Yeah.
I think writing, and really start to think about your writing and your editing skills. You got to be able to write emails, and you got to be able to make a case for things. I think like maybe even taking some writing courses, or maybe even putting your writing into some of the AI tools and see what it corrects and changes, so that you're really self-aware about it. Not self-conscious, but self-aware, so that you can start to get better. And one of the things that folks are saying that are, it's a big issue as it relates to communication is people want folks who can make a case with facts and not feelings. They want people who are able to say, hey, here's correct analysis of what's happening. Here's what clearly articulate what I think we should do about it, that sort of thing, right? And they want people that are willing to pick up the phone and have an actual conversation. A righteous debate at work can actually pivot you into different rooms that you've never been in before, because people want someone with a strong opinion, a strong point of view, but who know how to articulate it in a professional way.
I'm glad I sprinted over to the desk for this conversation. Andrew, great to have you here in studio with us. Thanks so much.
Thanks for having me, man.
Andrew McCaskill, LinkedIn career expert, joining us here on Yahoo Finance. Everyone, one of the other major areas that we're tracking over the course of this week, new bond alerts. The U.S. Department of Treasury is introducing new Series I bond rates. Now, the inflation-linked bonds will pay 3.11% annual interest rates from November 1st of this year. That's through April 30th of 2025. And that's actually down from a 4.28% yield that was offered last May. But let's back up. What is this bond rate that we're even talking about? It's a sort of a savings bond that offers investors both safety and protection from inflation. They're considered some of the most low-risk investments, and they're backed by the full faith and credit by the United States government. So, I-bonds are not the same as traditional bonds. Traditional bonds are all fixed yields, while I-bonds are a mix of fixed and variable rates, and that variable rate adjusts for inflation every 6 months. For this year's I-bond rate, it will be split between a fixed 1.20% portion and a 1.90% variable portion. So, if you already own an I-bond, what happens to that variable rate now? Glad you asked. The Treasury Department announces the new variable rate pegged to inflation every May and November. But the date when the rate changes for your bond is every 6 months from the issue date of your bond. So if you bought one back in September of this year, say, your variable rate changes every March 1st and September 1st. So on March 1st of 2025, you can expect that new variable rate of 1.90% to take effect. But your fixed rate will stay the same. So to buy the Series I bonds, you just basically head on over to treasurydirect.gov. And on the other side of this, as we move into November, the holiday travel season right around the corner, and if your Thanksgiving flight is canceled or significantly delayed, you are now automatically entitled to a refund thanks to a rule from the Department of Transportation. Let's get to it now. Here to break it down, Yahoo Finance's own Rochelle Akufo. Rochelle, what do we know?
Hey, Brad. Well, as Mariah Carey said, it's time, as she launched it off at the crack of dawn this morning. Now, the Department of Transportation's most consumer-friendly flight refund rules are now in full effect. So if you're flying anytime soon, this is what you really need to know. So first off, if your flight is cancelled or significantly delayed at your departure or arrival airport, so we're talking a shift of 3 hours or more on domestic flights, 6 hours for international. In those cases, the airline must refund you automatically. So no hoops to jump through, no questions, just getting your money back. Now, the airline, of course, will try to offer you alternatives like vouchers, but you don't have to accept them. Plus, if airlines move your flight to a different airport, tack on extra layovers, or even downgrade your seat, you're also eligible for a refund there as well. And for travelers with disabilities, if some of the key accessibility features become unavailable or the original routes change, airlines will owe you as well. But it's not just flights. Ancillary travel services are also included as well. If you have checked baggage delayed by 12 hours or more on a domestic flight, that's refund worthy. And then for international flights, you're eligible if it's delayed by 30 hours. And if you paid for some extras, including for Wi-Fi, in-flight entertainment, or seat selection, but the airline didn't deliver on those are also eligible for refunds as well. Plus, a helpful new rule included: if you get sick with a contagious illness and you can't travel, you'll get a transferable travel voucher valid for 5 years if you can provide valid documentation. Now, for all of these, airlines must process refunds within 7 business days for credit card payments and 20 days for other forms of payment. So time is of the essence. We know people are going to be booking their travel, so always important to know your rights and keep an eye on some of those airline stocks as well, as we're expecting a bumper year for travel this holiday season, Brad.
Yeah, and keep tabs on those promises that were made to you when you booked the ticket as well, because if they don't come to fruition, sounds like you get a little bit of that money back here. Rochelle, thanks so much. Coming up, everyone, the state of small businesses. We air the first episode of a 4-part series where Yahoo Finance explores the world of entrepreneurship. Stay tuned. Small businesses are a driving engine of the U.S. economy. According to the Bureau of Labor Statistics, small businesses contributed 55% of the total net job creation from 2013 to 2023. But many businesses fail in their first year or even fail to make it off the ground in the first place. Here with some of the tips on how you can build a successful business, we've got Elizabeth Gore, who is the co-founder and president of Hello Alice. Elizabeth, great to have you here with us. We should mention as well, Hello Alice is a free online platform that helps businesses launch and grow here. Elizabeth, as you think about the keys to just getting the business off the ground for so many entrepreneurs out there that are trying to make sure that they don't become one of the failed statistics, how can they ensure that they're setting the foundation for a long-standing business?
Well, howdy. You know, I'm actually optimistic right now about small businesses, those who had to shutter during COVID are coming back savvier, and their number one focus right now needs to be diversifying their cash flow. So starting with more money than you normally would and being smart about how do you use operational credit? How do you apply for grants? How do you get the SBA to back you with a loan? Right now, we need to start with more capital, even though capital is expensive, but there are different ways to do that.
How are you seeing small businesses fare when it comes to continuing to be a driving force, at least within the employment situation, as we continue to monitor it, fresh off of some of the data that we got this morning, which, of course, on aggregate was well below expectations. But for small businesses, what are you seeing out there in the environment for hiring right now in their job planning?
Well, on one hand, we have 5 times the amount of small businesses launching in America than historically. So that's the good news side. The tough thing right now is still hiring. So if you're looking at from living wage jobs all the way up to a skilled labor, there is still issues out there with that hiring. I say get out there fast and be proactive in your community before you open those doors. So try and tell people you're coming, cultivate those potential employees, get out in your community, go to your chamber of commerce, go to community events, and get the word out that you are hiring. Put it on social media even before you open those doors, because it is a tough job market.
I want to get to some of the tips that you have, and especially around how small businesses can secure capital and find grants and find funding as well. What are some of your tips for how small business owners and operators can ensure that they do have the operating capital that's necessary through some of the programs that are publicly placed?
Yeah, so my favorite thing that's very underutilized are small business grants. And those are non-dilutive. They're out there. Yes, you might have to do a lot of applications. However, this is, quote, free capital. They might come from your city, your state, your county. They might come from organizations. On Hello Alice, we have the ability to scrape the entire internet for grants for you. Also, every department within the US government offers grants. So it's really something to look for. The second thing is I'm a big fan in being smart around operational credit. So think about getting that small business credit card, using it smart, paying it off, but earning points, earning discounts. That is another way to be smart about capital.
And so just lastly, while we have you here, as you think about the environment for small businesses and the challenges that many small businesses have been able to overcome, but then as well, just how they're thinking about the infusion of offsetting some of those challenges. And some of that's with the infusion of more technology. Where are you seeing small businesses really tap in to technology, leveraging that to their advantage here, where, you know, it's not going to be the same type of spend as a Magnificent Seven company on technology, but it could be something that makes a larger impact on how they're effectively able to operate their business?
Well, I mean, they're small businesses and they're magnificent in and of themselves because they're spending 90% more than in previous years on software. So that means they're using accounting software, they're building their own websites, they're using things like Shopify and others to get their storefronts open early. So it is very smart and savvy to take advantage of the software out there for your small business, and they are, which is really exciting. I also think that'll lower fail rates because it's giving small business owners time back, which is the toughest thing as a small business owner, but also the efficiencies, the cost savings, and so on. So really excited to see that they are spending more on software. And I have to say really quickly, use cyber software as well. Cyber attacks on small businesses are very strong right now, and that is a software that cannot be overlooked.
Elizabeth Gore, co-founder and president of Hello Alice. Elizabeth, thanks so much for taking the time here.
Real pleasure. Thanks.
Thanks. Keeping with the theme, small businesses account for 99.9%. Yes, you heard that right. 99.9% of all U.S. companies and represent 43.5% of America's GDP, according to the U.S. Chamber of Commerce. But where do they all start? In the first of a 4-episode series, Yahoo Finance explores the world of entrepreneurship by delving into a specific stage of each small business building process through inspiring stories from those who navigated this journey. First on tap, we've got Talea Beer Co., an anti-beer bro brand founded by 2 New York City female entrepreneurs whose concept was to reach beyond the typical beer bro.
We really felt that there was an opportunity to create a beer company that spoke to a broader audience beyond the typical craft drinker, who we endearingly refer to as the beer bro.
You can never, never, never know too much about who your customer is. Here's how one Brooklyn brewery entered the crowded beer industry by turning to market research and focusing on an overlooked demographic.
Talea is known for fun, fruity, sour beers, along with beautiful spaces.
Totally on trend. The beer industry is moving away from traditional beer styles, from regular hops and regular pilsners, to more interesting and more unique flavors.
We are New York City's first and only female-founded brewery, and we are here to expand the craft beer market.
That's a big plus. Anytime you have a backstory where you can differentiate yourself as an owner's story, something that separates you from an incredibly competitive field, that's a huge, huge, huge opportunity.
We both loved craft beer. Tara and I met at a startup here in New York City. This was a beer e-commerce startup, so we had both kind of taken our steps from our more traditional corporate careers into craft beer. And within 3 months of knowing each other, we had formed the entity that's now Talea. When you start a new company, you should always have a problem in mind, a problem that you're trying to solve for someone.
Why should you exist? Why would your business be different than any other business similar to it? Those are the questions you need to answer before you put your first dollar and your first brow of sweat into this opportunity.
A lot of craft beer brands are very sporty, and some craft beer brands are very misogynistic in an overt way. So it felt like there was just clearly a gap in the market in terms of the packaging and the way the brand was speaking to consumers from the shelf, trying to get into their shopping cart. I started with a hypothesis that women were not being attended to by craft beer because that was how I felt as a customer of craft beer.
When we were, first testing our hypothesis out in the market before we had our own spaces, 9 out of 10 times we would convert women. And it's the best feeling because they haven't been spoken to. No beer companies are trying to expand craft beer to this consumer.
Testing any food business, any food product is incredibly important. You can't over-test. And in fact, you have to test correctly. You need to find an independent testing opportunity where you're testing it on a broader market of people that don't know who you are and get real, honest responses to the product.
We did a lot of market research.
Market research is understanding the behavior of specific market groups related to what your product offers, trying to find out the level of interest in that particular product and how it might translate into sales. Everything is incredibly competitive. You have to have every strategic advantage. The more you can research who your market is, the more you can scientifically analyze what those people's behavior is, the more opportunity you have to beat all of these competitors that are in the marketplace.
And research did show that despite the craft beer drinker being 70% male and 30% women, those 30% of women, 72% of them felt that craft was treating them as an afterthought and were frustrated by that.
A lot of market research is based on money as much as it is on time. To buy market research from some of the companies that actually produce it can be quite expensive. It can cost thousands of dollars. That is part of the opportunity cost of getting into business. You can certainly do market research in a matter of a few weeks, a relatively short time. The question is, do it until you feel you have enough data, either pro or con, to justify or change the product idea that you have.
When we were building our original business plan, our first concept was let's make one beer, and the holy grail would be getting it on the shelf at Whole Foods. But seeing the amount of overhead that's required to operate a brewery of our scale, as well as the overhead around marketing and promotions and, HR, all of those costs really need to be covered by more tap rooms.
To make a profitable business, we needed to build a brewery of our own and build tap rooms through which to sell the beer.
Our Williamsburg location, which is our flagship brewery, it's our production facility, it's also our first tap room. That was about $2 million for the construction side of things and our architect. It was another $600-ish thousand for all of the brewing equipment.
Okay, I want to stop there 1 sec. She hasn't mentioned what's called soft costs. And the soft cost can be an extremely important and expensive part of the business, which includes things like pre-opening payroll. That can be 20 to 30% of the entire investment. Often, beginning operators don't include that in their early calculations.
This year, we're on track to brew around 7,000 barrels. Of that, 75% of that volume will go out the door with our distributor to hit restaurants, bars, and retailers around New York City. And the remaining 25% stays in-house and is sent to our various tap rooms for people to enjoy.
When you look at a financial snapshot of our business, right now, about 75% of our revenue and the majority of our profits are coming from our physical tap rooms. In our perspective, it's a great model because wholesale is a profitable marketing arm, and the more tap rooms you have, the more profit we can make because we're expanding the most profitable part of a restaurant, which is the bar, but we've also vertically integrated, so we're making all the beer ourselves.
Vertical integration is a huge plus. So she's integrating her systems where she's selling to as many clients as she can in as many different venues, which is exactly what you want to try to do. But running that operation is the challenge. You have to keep in mind, every food business is a manufacturing business, and manufacturing businesses are complex. They have issues in production, they have issues in process, they have issues in resources, they have labor issues. And each one of those has problems that need to be addressed on a daily basis.
Our end goal right now is just to keep going on this path and make the business as stable and healthy as possible so that we can continue growing in a sustainable way.
We're working on opening our 5th tap room. It's right across from Madison Square Gardens, and it's going to be our next foray into Midtown.
The concept behind this space is to invest a minimal amount, which for us is about 10% of what we've invested into other full build-outs here in the city. So it's really a trial run and really test the neighborhood before we make a full $1 million plus investment in building out a permanent space.
One of the things that's important when you expand a company is to realize that not everyone is going to respond the same way to your product. So if it does work, or if the sales are not quite the same or the profits not the same, they need to have the data of who those customers are, who those customers weren't, and why it was or was not successful.
Don't let perfection be the enemy of progress. Try making a minimum viable product, try selling it, try getting feedback on it. Don't let yourself wait till you have the absolute perfect thing and the perfect packaging and the perfect name. That's never gonna happen. Sometimes you just need to start and get going.
Coming up, I'm joined by the host of the Financial Freestyle podcast, Ross Mack, where we'll talk about key advice for entrepreneurs and small business. Stay tuned.
But when it actually comes to making a business, right? Are you solving, are you first saying, let me solve a problem? Is this profitable? Like, what are kind of the things you guys did, and what advice would you give to those young entrepreneurs?
I think it's important to solve a problem that you're passionate about.
Passion.
Because if you're not passionate about the problem you're solving, then you're not going to have the stamina to continue when things get tough.
That's the advice of Squire Technologies co-founder giving to up-and-coming entrepreneurs. Dave Salvant himself, having started Squire nearly 10 years ago, and he joined the Financial Freestyle podcast with Ross Mack this week. And Ross is here with me now. Ross, great to have you here in studio. I mean, what do you think about this advice for entrepreneurs?
I think it's great advice, right? I think, when we go on social media, I think the new thing is everybody wants to be an entrepreneur, but I think people don't understand that, listen, the statistics are always against you, right? Within the first 2 years, 20% of small businesses are gonna fail. Within the first 5 years, half of them are gonna fail. And so when you listen to that advice, you gotta really understand, one, am I doing something that I'm passionate about? Because there will be tough times, right? And on top of that, now you gotta say, am I solving a problem? And do I have that competitive advantage that will help me withstand and actually bring actually beat out other competing businesses? And I think that, like I say, when you go on social media, everyone's like, oh, you don't want to work a 9 to 5. Listen, man, work the job if you are passionate while still working on your business to actually get it to the next level, because that's what Dave and his partner did as well.
Yeah, it was amazing to see Dave and hear Dave's wise words as well. I remember interviewing him many years ago, and even as we were looking at the stats that really put into focus how much more difficult it becomes to maintain that business over time. Great to see Squire continuing to find success as well. Great conversation as well. People can check that out, and you can watch Ross Mack on Yahoo Finance's Financial Freestyle podcast every Monday, 12 p.m. Eastern, on your favorite podcast platform. Coming up, everyone, open enrollment. It's here. We're breaking down how you can choose the right health insurance plan for you. That's next. Open enrollment starts today, and millions of Americans will begin the process of choosing their healthcare plan. If you're enrolling through the ACA exchange, you have from now through December 15th to choose a plan on healthcare.gov. For Medicare, the deadline is December 7th. And if you have insurance through your employer, well, just keep an eye out for their email notification or however they'll notify you. And if you're eligible for Medicaid, you can enroll pretty much anytime. Here to break down and help choose the right plan for you, Danielle Kunkel-Roberts, who's the Boomer Benefits founding partner here. Danielle, great to have you here with us. So first and foremost, we ran through the timelines, and so what are the expectations for the different types of plans, and if there are any material changes that people should be on the lookout for this year?
Yes, it's always something to look out for, because you can't assume that the health plan you have today is going to be the same health plan in January. We see this especially in the Medicare community, where plans make their annual notice of change come out in September, telling you everything that's changing on your plan for next year. This might be something important. It could be one of your important medications is dropping off the formulary. There could be changes in premiums and benefits. So you always want to review that carefully. If you have employer insurance, your open enrollment could happen any time of the year, but a lot of them happen in the fall. And this is when you want to look at the differences between networks they may offer you, such as an HMO or a PPO. And also sometimes you may see a low deductible or a high deductible plan. You want to think about your plan usage, how much you're using your healthcare when making determinations on which plan is going to be right for you.
Okay, and so you started to get into it there. Some of the tips for choosing that right plan for you. What should people kind of be keeping in mind as a good rule of thumb as they are evaluating different plans?
Sure. Well, first and foremost, across all the spectrum of plans, you want to make sure that your preferred providers are in the network. Keep in mind that this isn't just doctors, but it can also be hospital systems. It could be durable medical equipment providers, medical suppliers, and you want to check first to make sure that you'll be able to access those providers in the plan. And then most health insurance plans offer drug coverage, so you want to check there. Are the medications you take in the formulary, are there any step therapy or prior authorization limits that could affect you? This is all research that you want to do before making that final choice.
And so with this in mind, when you're perhaps talking even with your doctor or your practitioner about making sure that you'd still be able to maintain a relationship with that doctor, what are the right questions that you could or should be asking even while you're going through that type of discussion with a medical practitioner?
Yes, of course. So the key phrase that you want to use is in the network for. So you will ask your provider, are you in the network for my Blue Cross Blue Shield HMO? Or are you in the network for the United Healthcare PPO? We want to make sure that you're specifically using those terms, because these big brand carriers, they may have several different networks that are operating in your area. And so you want to make sure that the answer you're getting from your doctor's office is correct. And then always go to the plan's website, where you can access that provider directory online to verify that information.
And just lastly, while we have you, the Medicare deadline is next week. How can one be sure to choose the right Medicare plan for themselves?
Yeah, this one is tricky because there's several different types of insurance. So from October 15th to December 7th, this is when you can change your drug plan or your Medicare Advantage plan. If you have Medigap insurance, the annual election period doesn't affect that. But like I said earlier, your plan is going to change for next year. So you want to compare the options that are available to you, and you can do that on Medicare's website, medicare.gov, where you can find the different health and drug plans, determine which ones work for you, check if your pharmacies are in the network, and then do your research and work with a reputable agent who's going to be able to help you spot anything in that plan that you didn't consider.
Danielle Kunkel-Roberts, founding partner at Boomer Benefits. Thank you so much for taking the time here with us today to break this all down. Critical time period for a lot of folks out there.
My pleasure.
We've got much more on wealth after the break. You're watching Yahoo Finance.
Welcome to Stocks in Translation. I'm your host, Jared Blickery, joined by the voice of the people, as always, Sydney Freed. Thank you for tuning in. Before we jump into the conversation, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, wherever you get the podcast. And today we are welcoming Tom Sosnoff, a man who has been at the entrepreneurial forefront of trading for decades, from institutional to retail. You might be trading with his Thinkorswim platform, which he sold to TD Ameritrade back in 2009. These days, he is the CEO of Tasty Live, which he also founded along with Tasty Trade, and a veritable media mogul here. I know you do daily market commentary, which I've been watching, and you have some interesting ideas about the market. And let me just recap. Full disclosure, we're recording this on the last day of September, so the end of the third quarter. Stocks are up, but we didn't really get that contribution from NVIDIA or the chip stocks, and so the rally broadened. And what are you seeing in the markets right now?
I'm seeing a market that's, well, again, remember, I'm a little bit of a contrarian, so you got to be careful with me when you ask questions.
That's fine.
But I'm seeing a market that maybe it's a little frothy.
Frothy.
Can you define frothy for our viewers?
Yes. Frothy, to be fair, frothy just means that when you're a trader or an active participant in the markets, I think of frothy as you have more like velocity of risk to the downside than you do to the upside. That's all it means.
To be fair, I mean, this is the best year through September I think we've seen since '97 in the S&P 500, so it's an outlier. It's doing even better than last year, which was a great year. And last year we got that spurt to the end, which really propelled things. But we're getting ahead of ourselves, and we want to tell everybody what is going to go on in this episode. So our word of the day is liquidity. We're going to get to that definition in a second. This episode is brought to you by the number 95. That is the percentage of trading that has moved off the floors of the exchanges to electronic trading, and that's probably conservative. And Tom, we just got your big picture views on the market, so I want to get to liquidity here. We've defined this before on the show, and just as a refresher, liquidity refers to how easily an asset can be quickly converted into cash without significantly affecting its market price. And there are different orders based on liquidity. You have market orders, limit orders, but just how do you think about liquidity?
I think about liquidity two ways. I think about it as another word for efficiency, marketplace efficiency, and I think about it as, we would define it as tradable.
Okay.
So if something is liquid, it's tradable and it's efficient. And when you're a customer, like I am, like you are, everybody, participating in the markets, the most important thing is to trade in liquid markets. It's one of the great things about U.S. markets is they're generally liquid across the board, across the whole spectrum. But the few, let's call it the top 200 underlyings, are very liquid.
I'm interested to know then your approach to market. How do you select trades? If you're not a technician, what are you looking at before you get in?
If you're looking at price, you can. I mean, I'm a junkie, so that.
So you're immersed in the market. You got to feel.
Yeah. Only every day for the last 40 some odd years.
All right.
But I would say that the first thing is some people will look at things like it's subjective price extreme. So, for example, you think something is expensive or you think something's cheap, because there is no way of actually defining expensive or cheap. So it's subjective price extreme. And then I'm a little bit of a volatility freak. So we measure everything on liquidity and levels of volatility. Volatility in relation to itself. So the volatility, for example, on Amazon, on Intel, on NVIDIA, relative to itself, meaning that is it high
for that particular
underlying, right?
All right.
Sometimes when I think about the word volatility, I also think about the word risk. What does risk mean to you?
No, risk means opportunity. So so volatility is a fear gauge, right? Essentially. I mean, volatility indexes are
roughly,
fear gauges.
yes.
But volatility, the definition of volatility is expected move. So when volatility goes up, the expected move is greater. When volatility contracts, the expected move is less. And in reality, when volatility goes up, the risk is less, not more.
But when it goes down?
When volatility goes down, meaning when volatility contracts, the risk is greater. Because volatility is the only indicator, it's the only true math equation in finance. So in other words, price is not mean reverting, but volatility is mean reverting.
By definition, by the way it's constructed. All
exactly.
Right. Can you tell us about your history? You're kind of a serial entrepreneur here.
Yeah.
We talked about Thinkorswim as a platform. I happened to be using TradeStation back in early 2000s, and so that was mine. But it was
sure.
I'm very familiar with it, and why did you get into this business in the first place? Was it about democratizing finance?
No.
What were you trying to give to
I didn't even know
traders?
what democratizing finance meant.
I think it's a relatively recent term invented by millennials.
I need a
Gen Z.
definition for this.
But
I didn't understand that term. I mean,
So why
I didn't
did
even
you
know what
get into it?
entrepreneurship was. I was a pit trader in Chicago in the S&P pit for about 20 years, from 1981 to 1999, 2000. And I basically traded one product my entire career. And I was a successful pit trader. Let's just leave it there.
Mm-hmm.
And I traded index products. And as we're getting closer to 2000, the market was starting to go, a lot more of it was going electronic. And I could sense that we were going to lose market share from standing there. We were dinosaurs. Pit traders were essentially dinosaurs. And so I had this idea to build Thinkorswim, and myself and my partner Scott Sheridan, we took all the money we had made in the last 15 or 20 years before that, and we rolled it into a crazy idea called Thinkorswim. And there was no such intent to democratize anything. What we thought was we had a certain level of know-how about options that hadn't been popularized, and we took that, basically we built technology around it and took it to the street. And everybody told us we were crazy, and it actually worked. And so we built an amazing company.
So let me ask you, you've exited companies before, including Thinkorswim.
Mm-hmm.
How long do you expect to hold on to Tasty?
We sold Tasty.
Oh yeah, you sold
Tasty
it.
Trade.
You sold Tasty Trade.
But you're
Tasty
still in
Live.
Tasty Live.
Oh yeah, it's the same thing.
Okay.
Oh, okay.
Yeah.
So it's sold.
One is
Yeah.
We sold Thinkorswim in 2009. We were a publicly traded company, and we sold it to TD Ameritrade for $750 million. And then in 2021, we sold Tasty for $1.1 billion.
How do you make a decision to sell?
You get lots of buyers at the same time, and then you don't have a choice.
You blindly pick?
It's a great question, because as an entrepreneur, first of all, it's a high-class problem, okay? So let's not...
Good problem to have.
It's a good problem to have.
Yeah.
And most times, nobody ever wanted to touch us. Like, we were like the black sheep of the industry. And then all of a sudden, when people get excited about you because they come after you, whatever it is, somehow everybody knows about it. I don't know how the investment banking world works, but when we built Thinkorswim, we had 4 offers at the same time, and when we built Tasty, we had 5 at the same. But it took 10 years. So we built it in 1999, 2009. We got our first offer, and then there was about 4 offers, and maybe 5. In Tasty, there was 5 offers, and that took 10 years too. We built it in 2011 and 2021.
I want to ask about retail trading.
Sure.
We've seen just a tremendous change just in the dynamics of it. And now we have more options, more zero-day options available. Just in general, how do you think the game has changed? And do you think it's affected the institutional side, or are things pretty much the way they were before the pandemic?
There has been some normalization in the industry, but to be fair, I really don't care about the institutional side. I'm an advocate for retail investing and for, self-direct investors, do-it-yourself investors. We don't even support institutional traders. We don't even take them on our platform. So we could care less. The industry itself has grown leaps and bounds because, one, we popularized, derivatives. And the cool thing about derivatives, it's just about capital efficiency. There is no difference between trading stocks, options, or futures. It's just about how much capital does it take to do this, virtually the same thing.
Yeah, and just for the viewers, derivatives can include stock options. They can include derivatives based on which are futures, contracts for different contracts. I guess they have in the
No,
UK.
contracts for differences are not legal in the U.S.
But those that would be for our UK audience that would understand that.
Yep.
Just in general, how do you see the options for retail traders expanding maybe into the future? Do you think anything new is coming down the line?
Sure. I think you're going to see. We've had some really important transformational periods, like obviously 2020, 2021. But I think you're going to see a broadening of underlyings that you can trade. Like, I think you're going to see everything from event-based, obviously politics, but eventually sports. I think you're going to see tokenization. We're going to digitize everything. It's just a matter of time. And we're going to tokenize everything, so you'll be able to trade virtually any product in a single currency anywhere in the world and clear it centrally. So doesn't have to necessarily be cleared. It might not even have to be cleared on a blockchain. So I think all of that stuff.
That's really fascinating. Do there need to be a lot of legal and regulatory changes? Do we need changes in state betting laws, or do we have the framework necessary to implement that?
Sports possibly need changes in state betting laws, but nothing else. And I think that what you're seeing now is that in the world of options, we call rate of change gamma. And the rate of change in just everything in the world now is lightning fast compared to the way it was
and
10
probably
or 20
going
years
up.
ago. And probably going up. So what used to take maybe 5 or 10 years to organically change is now changing almost instantly. So, the thought of, could we really get to tokenization in some way? And the answer is, well, 10 years ago I would have said it would take 20 years. Now I'm thinking, it can happen in 3 months.
Are there risks in that moving so fast now?
There's no risk, because the only risk is not doing it, because somebody else will do it. Like in the US, we control this massive pool of liquidity, which is why the whole world trades here. And it's why, it's why we're here doing this. It's why we have so much stuff to talk about. It's why you have all these different stocks.
We have a lot to talk about.
I mean, we have, it's why our marketplace is, bigger than the rest of the world multiple times over. And we don't want to fall behind. We don't want to be disrupted by somebody else, even though nobody's close. And so the answer is, I think it happens fast. I think it happens here.
Let's leave it there.
That's it for Wealth. I'm Brad Smith. Thanks so much for watching here. And you can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. You don't want to miss it.